Okay, I call this meeting of the District Washoe County Group Insurance Committee meeting Wednesday, May 25th, 2022 to order. We will go ahead and start with roll. It is 4:04.
Thank you. So Jeff Balzan, present. Eric Diamond.
Present.
Mike Dixon.
Present.
Rachel Drake.
Present.
Vicky Cooper is absent. Diane Lyon is absent. Tony McMillan, absent. Tony Marestro is absent. Dawn is absent. And Robert Munson
Is here, present.
All right.
Okay. And we'll go ahead and mark people present when they come in late. We'll go ahead and start. I'm going to move the public comment at the beginning. It's right before 2.01, so we'll go ahead and have public comment. Trustee Nicolette is here, and there we go. Welcome. Thank you for coming.
Thank you. So please pass this on to your colleagues. That's your first assignment. Share the love with them too. So I reached out to Jeff because, I mean, I know what insurance is, I know what groups are, and I know what committees are. But exactly what you do, I reached out to Jeff so he could help me understand. And I will say that I'm not surprised, having been in group insurance for many, many years up at Nevada System of with Nevada System of Higher Ed at TMCC. I know the challenges. I know that you are very cognizant of balancing the needs of your insurees, of the budget, of maintaining costs, and yet providing the health care, the group care that each person needs, whether it's an employee or retirees. And so that is a huge job. And I represent today the Board of Trustees to thank you for doing this deep dive into very important work. I will speak for them in this way. We do understand that the decisions you make are very important, not always easy, and are very impactful. And we thank you for that. And we also recognize that as hard as we each try, as a trustee, I know this, we just can't make everyone happy because we can't meet everyone's needs. But darn it, we keep trying. We keep trying to do the best that we can so that our employees, our retirees are healthy, they feel safe, and they have the care that they need as they need it. So thank you very much for that. And I want to read just a bullet point that Jeff shared with me that I think is worth reading. The committee has been open to hearing ideas about how to provide cost relief to the district's health plan and to plan members, such as the Specialty Medication Cost Relief Program that was presented to the committee earlier this spring. We know that that is a big issue nationwide, and thank you from the Board of Trustees and Diane Nicolette for grappling with that. It's extremely important. You are appreciated, and we thank you for your hard work. And please continue to hang in there with us. Thank you, and enjoy your summer.
Thank you very much. Appreciate it. Okay. Item 2.01 is presentation and discussion of the Washoe County School District Group Insurance Internal Service Fund as of March 2022. Welcome.
Hello, Jessica Young, Controller. So, as of March 31st, 2022, the Health Insurance Internal Service Fund is at a $1.8 million deficit for those 9 months. For some comparison, if we look at last year's financial statements as of March 31st, we were actually increasing our fund or our net position by about $4.5 million. And so it's about a swing of $6.3 million to the negative. And what has contributed to that is primarily the health insurance premiums that we've collected are down by about $2.8 million for these 9 months. And then the health insurance claims are up by $2.8 million. And so that accounts for about $5.7 million of that swing. I wanted to go back to 2020 to look at the health insurance claims to see how they compared, because I thought 2020 was more of a normal year than 2021. And we're actually only up by about $100,000 if we look at the health insurance claims from fiscal year 20 to 22. So we can see that fiscal year 21 was really kind of depressed as far as the claims go. But anyways, so that is my analysis on that. If you have any questions, I'd be happy to look into it.
Questions, Jeff?
Jessica, thanks for your presentation. So just one clarification. When you were comparing FY 20 to FY 22, it was for the calendar year or the fiscal year ending March 31st?
It's for the first 9 months of the fiscal year in each of those years.
Okay, thank you.
And I just want to ask for clarification. In 2020, didn't we still have OPEB, were we still getting that put in? So that would change those numbers a little bit too, because we don't get that anymore.
Well, I was only looking at the claims, the health insurance claims. Like how much were they different in fiscal year 22 than were they in 20? Because that is accounting for a large portion of this swing.
And I'm just going to posit this as an idea, and I don't, it's anecdotal, but I know a lot of people during 2021 put off procedures because of COVID. And I'm wondering if we're seeing a huge spike because of procedures that were put off and now people are doing them. Will that taper off in the next year or two, or will it continue? I don't know. And again, it's sort of anecdotal, but I do know a lot of people that I talk to put off procedures and are now doing them or have done them over the course of this year during spring break. And
well, that's one of the reasons I went back to 2020 is because I wanted to see the difference from that year. And so what it looks like is that we're having a pretty normal year this year. It doesn't look like it's higher than it was in 2020. It's just a lot higher than it was in 21.
And just a question, and maybe Emily might know this too, but you said the premiums are down, and are premiums down because of unfilled positions? Is that one of the reasons? Okay, that's what I figured. Okay, any other questions? Okay, thank you very much.
Thank you.
Okay, 2.02, presentation and discussion of the Washoe County School District Group Insurance Claims Experience Report as of April 2022. Hey, Lloyd, how we doing?
Doing good, Robert. Thank you. Lloyd Barnes, LP Insurance Services for the record. Okay, we are going to jump into the April claims report that you see up on the screen. So probably a good dovetail from the last conversation and presentation on the financials. As we look at Exhibit 1 on our monthly claims report, the executive summary portion of it, our enrollment counts for this current year are down a bit. Sort of knew that. We had a little bit of conversation on that just a minute ago. And our monthly paid claims on line 4 also actually somewhat favorable compared to last year, down about 8.7%, running about $5 million a month right now, which yields a composite cost on the claims side of $722 per employee versus $787 $1,269 last year, so again, down about 7.5%. As we add in the fixed costs there, you can see those are also down. Again, fixed costs are a function of the enrollment count, so that makes sense. So that gives us sort of an all-in of running of about $5.4 million per month right now, compared to 5.9, basically 6 last year. So down about 8%, 8.6% to be exact, with a composite cost of $777.47 this year, down 7.4% from last year. So far this year, only have a single large claimant presenting, compared to our significant number of large claims that were there last year. But again, that's still a little early to make too much out of that one. As we look at Exhibit 2, however, this is where things start to get a little interesting, which is, we've talked about this, when we look at things comparative to last year, and we are still seeing that uptick in costs. And again, this is a rolling average, so this tries to smooth out those costs so that we can see them over a little bit longer period of time. And that's, what we are seeing is sort of that uptick in average cost, rolling 12-month average cost, per employee. So again, don't want to make too much out of this at this point. I think it's still a little too early. But this is somewhat indicative of what we're seeing with other self-funded plans. Back to your point, Robert, from a few minutes ago, I do think we are starting to see, we have been seeing, and I think it's continuing, sort of an increased utilization based on all of the complexities of 2020 and 2021. There's still a lot of feeling that people put off care, potentially to their detriment. Certainly with people with chronic conditions, there's certainly some feeling that those could have gotten a little bit worse over that period of time. I think that's a very anecdotal statement. I mean, I think there has been some research. I've seen a couple articles on that topic, but I mean, I think at this point it's still a little early to make that statement blatantly. And certainly for your group. But it is, I think, important to just sort of watch this, and it is something as we move through calendar year 2022, sort of where these costs are going. And as you'll see in a future next agenda item coming up here shortly on rate projections for 2023, some of this stuff's going to all come together. As we do look at Exhibit 3, basically rolling in the employee and retiree total plan costs, which basically was summarized previously. The April claims cost ran about $4.7 million, as you can see there on line 30. Which yielded a composite cost per employee for the claim side of $680.37, which is again down about 7.5%. So April was a fairly average month for the plan, just actually slightly below average month for the plan. And then the fixed cost pretty static there for a total of $390,000. So total composite cost for the month was $735.80. So again, the plan is doing fine. It's stable, but when you start looking at those average costs year over year, they certainly have ticked up quite a bit. I won't go through the other exhibits because those break down the active and retirees as we've done previously. So let you peruse those at your leisure. And then going to Exhibit 12, which is our large claims. We do have just the one that is presenting at this point. That is currently about $366,000. So we are tracking it, but it is still well below the $425,000 specific deductible that you have on the plan. With that, are there any questions?
Can you remind me, I know that in the past we've had a series of large claims, and I remember there was a time period in which we had a stop loss return at some point. What time of the year within our operational budget do we usually expect those to come in? And do we have any, do we expect any to come in?
Okay, so if we stay on this slide here, so your stop loss policy protects the plan for any claim over that $425,000. So anytime an individual has expenses in the policy year, which is basically calendar year, that exceed $425,000, then the plan gets reimbursed. So that can actually happen anytime throughout the calendar year, throughout the policy year. It doesn't have to happen at a certain time. However, just by nature of people's expenditures and how, start in January, it's not much, and by the time you get to mid-year or August, September, people that have large claims, generally they're going to start accumulating by then. So once that threshold is hit, so we start tracking it at 212, hometown, wow, that's blast from the past. Anthem tracks that and starts to report that out to the stop loss carrier at the 50% of the specific deductible, which is the $212,000. And then once it exceeds that $425,000, they'll file a claim with the stop loss insurance company. And then based on that, they'll provide the reimbursement back to the plan once that claim has been approved. Right. So typically you'll see those toward the end of the year. Sometimes it'll actually happen in the following year for claims in the preceding year.
And that's kind of what I was getting at. Obviously, we don't have any that are tracking presently in our current. Do we have any that are passed and expect to come forward, especially as we're starting to talk about our rate increases and we're talking about some of our overall expenditures increasing? Do we have any that are outstanding that we can expect that might come in?
I'm not aware of any that are carryover from last year.
Okay. Thank you.
There you go. Sorry. Long answer to a very simple question. Sorry, Eric.
And Lloyd, if I'm correct, the stop loss starts, so even if you have somebody that's a huge claim and they go up to 350 or close to the stop loss in December, it's the clock, the amount of money restarts on January 1st, right? So they don't.
Correct. The deductible basically
starts.
resets on January 1. Correct. The plan deductible, not an individual deductible. Yeah. You guys are like, this is old hat for you guys. You guys got this stuff down pat.
Quick question, Lloyd,
Yes, sir.
thanks. Hey, just clarify for me again, the total composite per employee cost. How do you get to that number?
Total claims cost divided by number of bodies,
The
by
body-
number of employees and retirees. So not total members. We call it subscribers or employees and retirees. It's the employee count.
So the employee count is the divisor, but the cost includes the dependent cost, correct?
Correct.
Okay, got
Correct.
it.
Just a standardized methodology for reporting. Yeah.
Any other questions for Lloyd? Okay.
All right. Thank you.
Microphone. 2.03, presentation and discussion of the Washoe County School District Group Insurance Anthem claims activity and turnaround reports as of April 2022. Pam?
Kelly, can you hear us?
There we go.
I see her bubble moving, but it's not.
Hi, Kelly. Can you hear us now?
I can hear. Can you guys
Okay.
hear me?
Yeah, that was something on our end. Thank you.
Oh, okay, perfect. I was like, oh no, I was looking at wires. What didn't I have plugged in? Perfect. So Kelly Dvorak from Anthem for the record. Good afternoon. Nice to see everybody here on the screen. We are looking at the medical claims turnaround report here, focusing on the column for April. So for the claims received in April, we had 14,396 claims. We had 98.65% of those claims processed in the first 14 days. And then in the 30 days, we had 99.7. And within the 90 days, we were at 99.99%. So pretty good turnaround in terms of April. If you scroll down to the PPO, break these out by plan type. For the PPO, we had 13,023 claims on that side that were received in April. We processed 98.59% in the first 14 days, and then 99.67 in 30, and again 99.99% in the 90 daes. No claims trending over the 90-day period at this point in time. And for the HSA, 1,373 claims. We processed 99.23% of those in 14 days and 100% by that 30-day time frame. If you scroll, I think that was it for that one. And then if we want to go to dental. Perfect. And for April, dental claims, we had 2,158 claims. 94.32% were processed in 14 days, and the remaining 5.68% were processed in 30 days. So we were at 100% of claims paid in the 30-day window. Any questions for me on that?
Okay, just for the record, I want to show that Tony Moresto joined us at 4:25. Any questions on the turnaround reports? No? Okay, thank you very much. Appreciate it.
Thank you.
And 2.04, presentation discussion of the Washoe County School District Group Insurance Wellness Program report to cover current events and programs as of April 2022. Welcome.
Mackenzie Howard for the record. Hi, everyone. I am really happy to be here for the first time. So first, we have some quick updates for wellness. The first one is in the beginning of May, we received our comp psych utilization reports. And so we looked at the period of January 1st through March 31st. We had a total of 204 members utilize our comp psych program. Of those 204 members, 74 of them accessed the program through either telephone or their email, and the other 130 members used the online portal that we offer. For our next update, we have a couple of Virgin Pulse challenges, and so in May, we offered one which ran from May 9th through May 15th. It was a kindness challenge, and it asked our members to conduct one random act of kindness every day. We had an average daily participation of 165. Upcoming in June, we have a process bias challenge, which will ask our members to be pretty self-reflective of any bias that they might be experiencing in hopes of creating a community that's more inclusive. Registration for this challenge will open on June 10th and run from June 13th through June 19th. Looking ahead, we are planning our wellness screenings, which is pretty exciting. We are in talks of trying to bring these screenings back to our school sites, which will be awesome. Well, the fasting for 10 hours won't be awesome, but the data that we receive will be awesome, and so we're excited to be planning these. Does anyone have any questions for me?
Questions?
The ComPsych numbers, those are greatly increased from what we previously have seen, yes?
That's a good question. This is the first report that I have looked at,
Yeah.
so maybe Laura would be able to answer that better.
We can bring back annual data if you want to see that.
Well, I have a vague recollection that annual data, we had tended to see less than 100-ish people a year actually call into ComPsych. And so I'm just trying to see if my memory is correct, if anybody else remembers different.
I don't think so. I think it is higher than that.
Okay.
But we can bring it back on our next wellness report just so we can analyze that better. But
Okay.
yeah, I think it's a little bit higher utilization because we tend to hit around book of business for them, and it's generally a little like I want to say more than 7% of our population.
Oh, okay. Thank you.
Any other questions?
I was just going to say the same thing. I thought it was a little higher, and I just wondered if it was because of this particular year, but I don't know that it's extremely high. But I'm really glad, thank you, to have you on board, and I'm really glad to see that we're trying to get back in the schools with the wellness, because I get people asking me that all the time. Are we going to have that opportunity again? And I think that's really great. So thank you and welcome.
Thank you. Very happy to be here.
Next item, excuse me, 2.05, presentation and discussion of possible action for the Group Insurance Committee to recommend possible changes to the Washoe County School District Health Plan for the plan year 2023, including possible rate increases up to 5% and/or changes of benefits. Welcome back, Lloyd.
Hello, me again, Lloyd Barnes, LP Insurance. Okay, now's the time where you can get the tomatoes and bananas out and start getting ready to throw them at me. So this is the time of year when we go through the exercise of doing some projections on costs and mathematically determining what we feel is what we feel the cost structure is going to look like in the future period. And the process is always a bit of a challenge, just because your plan does do that process, go through that exercise so far in advance, because we're looking all the way into 2023. And when we do our projections, we typically look at the most recent 12-month window of expenses. And going back to the previous report, when we look at that graph, right when things started to drop down significantly was April of 2020, April 2021, where you can see in the graph, and I won't take you back to it, I'm sorry, April of 2020. And so we start like dropping off all of these low expense months as we've now started looking into the future period. We actually did a preliminary exercise with this process last month with our last month's data, but we typically would go through and actually present to you in this meeting, and it did jump up about a full % from last month's projection to this month, based on sort of dropping off a really good month and adding in a sort of average to above average month. So timing is a little bit of a challenge with this exercise. So again, this is a mathematical exercise that we go through. We look at the most recent 12 months experience. We use a trend factor based on generally accepted underwriting and actuarial provisions for inflationary considerations for medical, dental, RX. We then look forward into 2023 and give you our best estimate of what we think the expense cost is going to be in relation to what the revenue is. So it's always how much revenue is being generated by the district and the employees and dependents and all of that, compared to where we think the costs are going to be and fixed costs. And that's the number that is reflected here, which is basically 6.79%. And then you can see how that would break down on the different PPO and HSA plans. So, again, the number's a little higher than I was hoping it was going to come out, but we have seen that uptick in costs. And as we do look forward into the 2023 calendar year, we are a bit concerned that those costs will stay elevated, and we have to project based on that expectation that they will continue sort of on that upward trend. So that's our projection at this point. I know there's going to be some further conversation around this, but that's where our math is coming in.
Sorry, go ahead. I just have a quick question. I know we used to in our reports get the 10-year trend of where our balance, the fund balance is, and I don't see that in our reports this time. And I'm just curious where our balance is and how that's been trending, since we haven't got that report. Yeah, that report would be via the finance and risk management area, so I'll defer to Laura on that part. Yeah, and it's not listed. We've reduced it down quite a bit, the report. But there used to be that graph that went back the 10 years. When I first got on the committee, it went back to the time when the insurance committee was in the negative for several years, and the district was building that fund. And so I'm just curious where we are in that ending fund balance.
I can ask to bring that back. Jeff, do you have any comment on that?
And for the record, Diane Lyon just walked in at 4:34.
So I'm just looking at the report that Jessica had presented a few items ago. Looks like, I don't have many years of history here, but it would be July 1st of 2020. The net position of the fund was at $28.9 million. And then on July 1st of 2021, the net position of the fund was $37.7 million. And as of the 9 months of this fiscal year, so as of March 31st, 2022, the net position of the fund is at $35.9 million. So not a lot of history there, but that's what we have in front of us.
Thank you. Any other questions?
I'd like to start with a basic question. I'm curious, as you talk about a projection for the next fiscal year, what happens if there's a surplus at the end of the, if we don't meet the projection? Where do those funds go? Do you know?
The fund increases, and that's the balance I was just
It
asking
just sits in the general,
about.
in this fund,
Correct, in the health fund.
in the health.
In the health fund, not in the general fund.
Thanks.
Since we're
And-
self-insured, I want to keep a balance.
Yeah, exactly. And I think, the important thing from our perspective, so I always liken this process to a checking account and a savings account. What we do is we look at the checking account. Your savings account is your ending fund balance, is your fund balance. And our job and our exercise is trying to see how we can best project your expenses to your revenues and how do those compare. Not taking into consideration, because it's not our role in taking into consideration the ending fund balance, what is or not in there. So we're trying to do our best to project where do we think your costs are going to be, and compared to revenues, what does it need to do to make sure that those expenses are covered.
And Lloyd, just a quick question. That ending fund balance, you want to have, what is it, 6 months? How many months of being able to pay out bills, since we're self-insured, do we want to have typically in that ending fund balance?
Yeah, that's always a great question, and always one that is sort of perplexing, because there's no right answer to that. There's no statutory requirement in the state of Nevada. There are some states that do have statutory requirements. Nevada is not one of them. The district has had sort of different strategies around that, and I don't have the current multiples of IBNR that you currently feel is an appropriate cushion for that ending fund balance. Obviously, the IBNR is an amount that is a liability for the plan no matter what. Mm-hmm. As we've talked in some previous meetings, one of the concerns that we're all having in our business is there's more and more of these claims that are potentially exceed your specific deductible and potentially could be excluded from the stop loss coverage in future years if they're an ongoing, for example, prescription drug claim. We've talked a little bit about that in the past. So sort of this catastrophic reserve concept. And so these are all things that sort of are baked into this need to have very, very robust and strong reserves so that you can weather whatever storm may ever exist, so that you don't have what you saw in that 10-year graph from 20 years ago when it was negative.
Yeah. Also, just curious, you used to give us like two different, or originally used to give us like 3 different projections based on risk, and then we got 2 the last couple times, and now we're only seeing 1 projection. Can you kind of just go into the history of why we're at 1 and what that means? And
yeah, absolutely. So what Robert is referring to is there was a time in which the district had requested we use what's called a confidence interval. I think that's the term that you recall back in the Tom Marshall days. And for lack of a better word, confidence interval essentially is the same as margin. It's the same exact thing. And when we would go through that exercise back in the day, you'd have a fixed projection based on no margin, or I think no margin was, can't remember what that, I think that might have been the 50% confidence interval. I'm not positive of that. And then to get to a 75% confidence interval or any others, we would then add margin. We would add a load to the projection based on just a simple formula of 1%, 2%, 3% to get to different confidence levels, which basically makes you more confident that those revenues are going to cover all the expenses that you project. Okay, pretty straightforward. A number of years ago, we started phasing that out because the desire of the management team at that point was, let's just show what is actual, and let's try to really focus in on the actual part and not add in that margin level. And so over the course of a few years, and it actually I think went back quite a few years when that was sort of phased out, we stopped presenting it in that manner. So a confidence interval basically is a margin. You could take this and add 1 or 2% and have a higher probability that those revenues are going to cover all expenses. Does that help? You're taking us back, Robert.
Sorry, Laura, I'm like missed you a couple of times.
No, that's okay. You can ask more questions.
No.
Before we get into even more discussions, and I'm sure we'll have more questions for Lloyd, I wanted to bring up some of the discussion that I've had with Emily, our chief of HR, and Mark, who was here on our last meeting, Mark Mathers, our chief of CFO, our chief of finance, our chief finance officer, in the business office. And we did meet with Lloyd about a month ago, and we were watching the rate adjustment at 5 point something, and now it's 6.79. And for those of you who have been here a while, or at least several years, and have to go through rate adjustments in the past, we know it's been hard, and it's been a hard pill to swallow, and to tell our members that we're having to increase rates or having to take away specific benefits. And we're coming off a pandemic of 2 years. Hopefully we're coming off a pandemic. I don't know. Sometimes it doesn't feel like it. But that's shown a lot of difficulties for all of us. We're lucky enough, most of us, to still be here in our positions and to have a paycheck, and we know others haven't had that luxury, but we're all starting to feel it, I think, a little bit now with the economy and looking at the rising inflation. And I mean, I feel it every time I go to the grocery store now and I'm buying my regular groceries. I'm like, where did that extra $100 go? That's interesting. Everything is quite a bit. So we've been discussing on how we can make this work for our members, and how we can try to give back to our members and make as little impact on rates with our members as possible, and benefit changes as possible. So we discussed a 3 to 5% increase and what that would look like. But it has been determined that it will be supported and recommended to go to and keep a 0% increase for this year for our members. So we're not, I don't want to say passing on costs, because those costs are going to be there. But we have a fund that, like Lloyd said, it's relatively stable. It's relatively healthy right now. We are seeing those increased costs. It doesn't mean that those costs are going to go away. We're going to probably continue to see that and monitor that, especially next year. But we feel that this year, with everything happening, on top of having a little bit extra cushion that we do have, we can probably support a 0% increase this year.
My only question is, and Lloyd might be able to address this, if I don't, a few years ago, it was like 16%, and it got down to 10%, and it was, I think between management a little bit and us as a committee, and it went back to the board twice, the Board of Trustees, because it was so large and what we were trying to do. My only concern, if we think, oh, well, we can make it another year, do you think that there's a likelihood that we're going to end up with this huge increase in a year rather than saying, okay, we'll do 1 or 2% this year and, then 1 or 2% next year? I mean, I'm just trying to be cautious here because that was a really bad situation, and we met probably 4 times or 5 over the summer, and it was not comfortable.
Robert, I think you're hitting on one of the reasons why I like this committee out of a lot of the committees I work with so much is you guys sort of understand, and you guys have been working with this for so long that you do understand sort of how this works, and I applaud you all for that more than you all will know. But, I think one of the challenges, again, because we're looking at it from a checking account perspective, that is a concern of ours as well. I think when you look at the math, unless things really, really sort of stabilize and or turn around, I think there is that potential that, your costs are going to be quite a bit more as we move into 2023. I don't want to get into the whole, what's inflation doing and all that, because I think that's still super unknown in the healthcare space. But I think that is one of the concerns. Anytime you use your savings account to basically buy down, which we've talked about this a little bit, to buy down or pay for a potential needed increase, is that over time that can compound on itself, and you can wake up as we're going into this exercise a year from now going, oh my gosh, when we project into 2024, now that number's gotten big. So that's the risk, is that you do have a compounding of the expense that you didn't take, plus now the needed increase for the future period. So that's the risk. Certainly, if you did make a small adjustment, any adjustment that you make is going to move the ball a little further, move the revenue side of the equation a bit. I'm a little bit. And Laura and Emily and Mark, we've had quite a few conversations on this topic, obviously, and we have and do support a 0% increase. That is something that we feel is reasonable in light of your strong fund balance position, and in light of the fact that it's really only been the last couple months that we've seen this uptick in cost, that I really would rather have a few more. If we could look at it in August, which we can't, and make our decisions in August, I'd feel much more comfortable giving a recommendation. But I think in light of the fact that we do have to make the decision, this month or very soon, I think it's reasonable. It's a reasonable position of the district, and we are supportive of it from an underwriting standpoint, that to go ahead and maybe be a little bit more liberal in the application of the increase this year. And I will say a little bit of hope for the best. I don't usually like to use that term, but hope for the best a little bit, knowing that there could be a little bit of compounding on that as we sit here a year from now. We might be having a different conversation. I don't envision, based on where we're coming from, it being as aggressive as some of the stuff we saw a couple years ago. And I think that's because we're coming from such a lower point. I think that would be a real anomaly to see it uptick that much. Long-winded answer, sorry, Robert.
Can I make it a little bit longer? Just to add some color from the district leadership perspective, Emily Ellison for the record. I think everything that Lloyd said has been very informative to our decision making. Of course, we worry about pent up healthcare, and I think if over the course of the last few months, as we've started to see an increase, if we were seeing a more dramatic increase, like a doubling, all of this healthcare that didn't happen, plus all the usual healthcare, that would give us pause. And then I think the number of large claims too is a factor. We have one large claim right now. Certainly don't want to put any energy in the universe to increase that, but that's a factor as well. And then one of the things that Laura and I have talked about is, of course we want to get this information out before employees leave for the summer. But when we start the open enrollment process, we're going to kind of do some re-education about it again and some kind of re-celebration about it, because it is important for employees that are feeling such financial pressures right now to not have this additional financial pressure as well. But all of us as members have an opportunity to keep this momentum, right? And there are a number of just really kind of small decisions that people can make that really make a difference. And so, for example, I was sharing with Laura that I've had 2 procedures recently, one at an outpatient surgery center and one at Renown. Exact same procedure, and the Renown was double the cost. And so helping to educate our members about those types of healthcare access decisions that they can make in order to continue to influence the trend, to try and keep it a little bit lower, but not discourage people from accessing care. I think that that's going to be another important part of the equation, right? Really kind of reminding all of our members how member decisions impact our plan, because we are our own carrier. So thank you for letting me add to that.
Thank you, Emily. And, go ahead, Diane.
I'm sorry. Can you help me understand, if I'm wrong, please tell me. So at some point, whether it's this year, next year, thanks. This year, next year, at some point, we'll have to raise the rates. Is that correct?
Again, Lloyd Barnes, LP Insurance. Yes, I mean, ultimately, yes. Healthcare costs are not going down. We will never have an extended period of costs going down in our healthcare system, I don't envision. So, yes, at some point that will come and catch up with you, and you'll have to make some adjustments.
So I just want to piggyback off what Robert said, that if you do, whether just even a little bit back here, then when you get to the point where you have to do more, it's not like a shock or a huge deal. I mean, I don't know if I'm explaining myself right. Yep. That we've taken care of business back here, in other words.
Absolutely.
To a certain extent.
And if the ultimate decision is to do let's say a 2% adjustment to move the needle a little bit, I think that would be a very fiscally sound decision. Now, there's other considerations in that from a HR risk perspective, from an impact to employee perspective and retirees. So obviously there's a lot of things that go into that, but we're going to always want you to err on the side of a little bit of an increase. We're supportive of holding the line at 0 for all the reasons I already explained. But if the ultimate decision was a 2% increase, I would applaud that, because I think that would be keeping ahead of the ball a little bit, so that the rock doesn't catch you and roll over you in the future.
Right.
Which I think is your point, Diane.
Yes, thank you.
Go ahead.
I actually have 2 things I'd like to talk about real quick. So Emily, I really appreciate that you just brought up that point about employee awareness. Something I was going to mention to the group is that the last 6 months, the principals and teachers I've spoken to about our just insurance work and our group policy, 0% have understood what it really means to be self-insured. So I do think there might be some room for us to be proactive around educating the 7,000 folks of what it really means when you say insurance and who's paying it, because I do think there's a little bit of a perception that there's a mystery man with a credit card somewhere covering costs. Swipe, right? And it's just taken care of. So, I mean, without discouraging, I really liked how you said that, without discouraging people about healthcare and wellness, advocate for that all day long, I think there could be some awareness about being more conservative with costs. So speaking to that, to your point, a question I have been wondering is, if we're talking 6.4% was a suggested premium increase for next year. How much money is that actually? Has anybody done the math? Is it just is it like $50 per person? Like the rough math I just did on just the employee only, it's $50 a person per 7,000 people. That's like 350,000. Is that what we're talking? Because what I'm wondering is with that number, to your point, if we're saying, we're going to meet that cost this next year without doing a premium adjustment, that's really what's coming out of our savings account using that analogy, which is pretty good. I'm curious how much money we're really talking about reducing, because the overall budget right now is $39 million. Is that what I've been hearing? Currently, the balance?
Yeah, I think the balance was at
35 million?
35,
So if next year, let's say things went as planned, and we really did have costs increase at 6.4%, how much of that are we covering through our fund?
It's about $5 million,
5 million?
roughly.
Pretty sizable.
Combination of district money and employee money for dependents and retiree money.
If you had a series of months that just say mid fiscal year you hit a crisis and we're like, wow, we're really just overextending on cost versus premium, is there an adjustment that's made? Has that ever happened?
It can be, as a self-funded plan, you can adjust your pricing and your benefits at any time. With benefits, typically you want to provide 60 days notice to employees if you were to make an adjustment to either cost or benefits. But it can be done. As a self-funded plan, it certainly can be done.
Yeah.
I don't recall the district ever doing that. Other plans have, but
Sure.
You generally want to keep things on an annual change basis. And that's why, back to everyone's point is, you're making a decision now, and we're not touching this thing again until 2024, in theory. So that's where that compounding can come back to bite you, because as we sit here today and make decisions for 2023, our next chance to make an actual change, to actually have numbers that actually hit the finances, don't start until 2024.
Yeah.
So these are really important and very, very, very good dialogue, and very key points and key elements that you're making. So I think this process is an important decision.
Jeff?
Thank you. So, Mike, to answer your question about mid-year changes, it's extremely difficult to make those changes mid-year, because if we were to do a rate increase, that comes at a general fund cost, and the board approved the general fund final budget yesterday, so that would require a mid-year adjustment to the budget, and the only way to augment the budget is if we have additional resources that we didn't plan on having. So that makes it difficult for a mid-year adjustment. How much did you say? $5 million?
I calculate roughly $5 million is the 6.79.
Thank you. So the last 2 fiscal years, we've seen some pretty hefty surpluses in the health insurance fund last year. I think that sheet said it was over $8 million, and it was even more than that the year before, I believe. So, I mean, I understand there's a concern about future rate increases, but I would be very supportive of a 0% or no rate adjustment this year, and using some of that fund balance we've built up over the last few years. Thank you.
And I would just like to say also that our members are experiencing, as you mentioned, like at the grocery store and everywhere else, huge inflation. I went and filled up my car the other day and it was like $5.65 a gallon at Costco. And so I think people are feeling that. Now, the district, if we did a, say, 6% increase or whatever, 1%, 2%, the district funds that for our members automatically because of our employee agreements. So that would be the district that would ultimately fund that. But for dependents, people with dependents would see that increase. And then also our retirees, who are the ones that I always worry about because they're on a fixed income, and Danny Kitts used to always remind us of that, but they're on a fixed income. And so even a 1 or 2% increase is an increase that comes out of their budget pretty heftily. So if we can maintain a healthy balance, even if we drop down 5 or 6 million and had 29 million. I think that, and then weather the storm at 2 or 3% going forward from there. And who knows, the inflation we're experiencing right now might just be an anomaly because of all the world events that are happening, and that might come down too. So I'm with Jeff on that. Go ahead, Eric.
I tend to agree there. I've been on the board, I think, since about 17 or 18, and I remember seeing our fund balance anywhere between 17 and 25 million and being relatively comfortable there. Now, I'm not in any rush to just spend our money and get back down to that. Seeing a healthy fund balance like we have is obviously something that is very positive, but risking, per se, the $5 million at a 0% increase is something that I really, really like. This is what we talked about last year. Anytime we can even remotely talk about a 0% increase for the members is something that I absolutely and very seriously take a stab at. So I think that that's going to be really a positive thing. And in addition, anytime that we can keep the percentages or any of the money from our members out of this fund is something that I think is incredibly important, especially because it's an internal service fund of the district. So it's at the dominion of the district whenever we put money into it. So if we can keep our members' money out of it at any time is something that I think is important.
So I just want to confirm that we are discussing a either very minor increase or a 0% increase with maintenance of all current benefits. Okay, thank you.
I just want to clarify, I'm going to continue to advocate that if we were to move forward with a 0% increase, that we have got to educate our members that wasn't because costs were low, that we are just able to absorb the cost, but change has to take place at some point, because I think that there really could be a misunderstanding that if you just catch the short version, and we know a lot of people don't read their email, right? So if the short version was 0% increase, people are going to, oh great, insurance costs didn't go up, which is not an accurate story. Right. So I don't know how we could really get in front of that messaging between our different departments, but it makes me a little nervous, because I would be worried of a bigger increase down the line. That would be tougher for folks. But I think if we can get in front of the education of informing people of why there's a 0%, that could be positive.
And I just want to piggyback on that. And I think one of the reasons why all the associations we're here is so we can somehow filter that back to our members. I know we have the WA today and we have a newsletter and whatever, but making sure that we get that information out to our members that, hey, yeah, costs aren't going up here, but it's not because costs aren't increasing. It's because we've been fiscally conservative for the last few years and we're able to weather a storm of, some uptick. I think Emily's point also about people calling around, I know people ask me all the time, they're like, I had no idea this place was more expensive, or Reno Diagnostic was cheaper, or this place, and I know my doctor wants me to go in for my annual, or my first time colonoscopy type of thing, and they gave me two choices. I have no idea which of the two choices is cheaper. I need to call them and ask them for projected, and especially because I'm on the HSA, I want to make sure I get the projected rates and whatever. But, or if it's really expensive, maybe wait till, another year. But that's not a good idea. But, I think how can we get, and that's one of the things, is how do we get to our members information about, more cost-effective options, whether it's prescriptions or whatever? And is there a way that we could, through, risk management, have a line set up where people could call and say, hey, I'm just curious, or do they have to call 6 different providers and hope to get an accurate, feedback? So.
Robert, might I jump in a little bit? Just let me hit on one point before, so I think I might be able to help a little bit with this. Traditionally, this has been one of the most challenging parts of health insurance and healthcare. We've all dealt with these, even as we've gotten into the whole HSA world, where people have higher deductibles and more responsible for their care. The idea was they become better consumers. The problem is it's so hard to shop for care, because no one will tell you what the cost of anything costs, right? So it has been a fundamentally challenging part of our healthcare system forever. Fascinating enough, as part of the Consolidated Appropriation Act of 2020, passed at the end of 2020, there was some provisions in there around price transparency. I won't bore you with all of it because it's a whole nother meeting in of itself, but a big part of that is requiring plans, health plans, insurance companies, administrators of insurance of plans, to begin the process of starting to push out price transparency for providers. How much do things cost? Giving employees, members, tools to actually start to understand what things cost from one provider to another. This process technically started January 1 of this last year, but not much to it. The first phase of that is something called machine readable files that starts to kick off in July, and that's basically where Anthem, in your case, will be publicizing a file that shows basically what things cost for a certain number of procedures. As we move forward into the future, 2023, then 2024, there are requirements that are mandated by law and by regulation that are going to require plans to start publicizing and providing tools for members to actually go out and search this stuff. So you're going to see a lot more conversation around this. It's still very much in its infancy and hasn't really made its way down to all of us, but it is coming, and it's going to take a while. We're talking multiple years before it's really operational and really functional, but it's coming, and I think it's going to be something that's going to be very good for our industry and good for us as consumers, so we can start to really understand that that procedure costs a lot more at this provider than at this provider, and actually be able to have a tool to go out and look and find that. Now, I'm excited about them. I think it's going to be a really fundamental change in how we access healthcare and how we understand our costs. Still a little ways out, but I think it is going to help. In the meantime, it's the in the meantime part that I'll defer to Emily.
All right. And that is going to be super cool, because I think if we go to members with a message of you should call providers and shop around and get better prices, they're going to say, have you lost your minds? I don't have time for that. Who has time for that? So really our thinking was around kind of two big concepts: understanding how our plan works, right? Because you're right, there's somebody's paying the bill, but it's not me. And then there's easy changes that people can make, right? So not you need to make 6 calls to figure out which doctor is going to do this test for the lowest price, but we know standalone surgery centers tend to be cheaper than hospitals, right? We know that going to urgent care is cheaper than the emergency room. So really that kind of just sort of high level awareness that doesn't require a lot of effort on the part of the member, but really just kind of in the back of your mind, remember, this is cheaper than that, or Reno Diagnostic, those kinds of centers are cheaper than utilizing hospital centers, that sort of thing.
I think.
I was just going to say, I know Kelly's listening in from Anthem, and Anthem is very much, I believe, going to be on the forefront of some of this stuff. They may already have some things that can help from a communication standpoint to start to gear up this process. I don't know that we need to dive into that too deep, but something that Laura, maybe you and Emily and Kelly and I can have some conversations on as we look into the future.
And I think.
Yeah, Lloyd, this is Kelly for the record. Just so you guys know, you're exactly right, Lloyd, in that we have the cost and quality stuff that's coming out from a machine readable file that will be posted. Definitely not for general consumer use, because you truly need a computer to understand and read it. However, we do have within the Sydney mobile app and on anthem.com some cost and quality tools. Now, not every claim and every procedure is out there, but I just did a search and you can find things like the cost of an MRI or a knee surgery or even a colonoscopy. So it will, if we have enough claims from specific providers that have come through our system, we will give average costs that would be applicable to the individual searching based on the plan that they're on. So we can absolutely help with some messaging, some communication, education on how to use the tools that are available now. And this will continue to be improved and expanded on as we move through all those CAA regulations as it relates to transparency.
Thank you. And I think a lot of members that I talk to, they're like, but they're on the preferred provider list. And so they assume because they're on the preferred provider list that they're going to be cheaper, when in fact, the reality is they're going to be cheaper, your percentage that we pay, but that doesn't mean that the initial cost is going to be cheaper necessarily because they're preferred providers. So I think that that's a misunderstanding as well for members.
And I think just healthcare consumers in general assume that everyone on the preferred provider list is charging the plan the same. Yes. Right? And don't realize that as insurance companies contract with providers, everything looks different. So I think you're right. There's a lot of misinformation.
I have so many thoughts today. On that note, I'm learning more about healthcare due to my relationship in my personal life. What I've just learned recently, on side note to that, is you can go to your provider, for assuming Renown, but the actual doctor that comes in may not be covered, and you could get stuck with the bill. I think a lot of people don't understand that. But I'm just wondering, with us having 7,000 employee members, we must be the largest insurance group in the region, right? I mean, do we not have some power to help negotiate in maybe a different viewpoint than has happened in the past? I mean, you're laughing, but here's something I'm thinking about in this conversation right now directly. Renown's shifting their primary care model to where you get a 20-minute appointment. And within the 20 minutes, that's all the time you get with your provider, and they're doing it intentionally. So therefore, when you say, hey, I'm here for this, but I want to talk to you about that, they say you got to schedule a second appointment. It's no different than not being able to get blood work results through my chart. You got to schedule a follow-up appointment. So there's all these co-pays and office visit fees, right? So I feel like now that we're learning more about, this is like our checkbook. Let's stick to your analogy because I like that. Maybe, I mean, is there not some options to go at this a little bit different over the, if you look at like the next 3 to 5 year plan, that if Renown's changing their structures to better meet their fiscal needs, why can't we have a little bit of conversation to do the same on that benefits us?
So I will just say that in the past, we were part of a health group, and we did do those negotiations through the health group with the Peppermill and the Diocese. There was like a ton of different employers that we grouped with and went out and did those contracts, which gave us that ability to negotiate. Several years ago, members wanted, there was a huge push for more options, not just Renown or not just St. Mary's, which were both basically wanting exclusive contracts. And so the district did an RPF, request for proposals, went through that process and looked at insurance companies. This is also confusing for our members too, because they forget now that we're self-insured because we have Anthem and they think, oh, they're our insurance company. That they don't realize that they're just processing the claims and that we are the district insurance. And so we sort of, I want to say to some extent, gave up that power to negotiate. I don't know, I could be wrong, but when we went with a company that now Anthem does that negotiation of contracts for us, and we're contracted through them. Am I off on that, Lloyd?
Wow, we're getting into some fun stuff today. Thank you, Mike. I could do this all night. Be careful. Be really careful. So, couple comments. Negotiating of contracts, sort of where Robert's going with this. Robert's absolutely correct. You were with the coalition. That was a purchasing group that negotiated contracts with hospitals based on for pricing, and you're no longer part of that. You basically rely on Anthem to do that. In many ways, and certainly in my opinion, Anthem actually has more leverage than the coalition does because they have more business with the providers in this community. I think they're the largest, they have the largest market share in our community. Certainly in certain other markets around the country they do. But either way, they're one of the top directors of care, holders of contracts with providers in this market. So they have a great deal of leverage. And as much as we all, close your ears, Kelly, get frustrated with insurance companies all the time, Anthem does a very good job in working on your behalf and other clients of theirs behalf to do just that, negotiate the best contracts, make sure that providers are doing right by their by the members, by the patients. And so the challenge becomes your ability as an individual group or even as Anthem to tell Renown how to do business. Could you? I don't know, maybe. There might be some dialogue that could happen if there were some things that were going on within the Renown system that, Anthem could help sort of spearhead that message or that cause. But again, they're an independent practitioner, and they sort of can do whatever they want to do, as long as within the contract terms that they have with all their different payers, and as long as it's legal and all of those other things. So I think the school district is in a very good place in your partnership with Anthem to be able to leverage them. I think there may be some things that we can engage Anthem in to help deliver those messages, help fight those battles for and with you as the school district, as a 7,000 employee district. So I do think there's some of that. Their leverage is going to come from the couple 100,000 bodies that they actually represent, every bit as much as it is from the 7,000 employees of the district. So I hope that helps a little bit. But healthcare is changing. We are seeing, blink a little bit too long, and we're going to see a whole new healthcare system in this country. And I think there's a lot of this going on, both locally and nationally. The healthcare providers have been under a lot of pressure over the last couple of years, just trying to make it work. And so I do think we're going to see a lot more change in healthcare on the provider side, and we're going to be somewhat at the mercy of our administrators, our Anthems of the world, to help us sort of navigate that. Great questions, though.
Diane?
There's two thoughts, if I might. Oh, everybody can hear my big mouth. First of all, when I'm in transportation, so I see a lot of people all the time. And I've heard people in the driver's room, they're going to have a procedure here or a procedure there and stuff. What my first sentence is to them is, you need to be proactive about your health care. Case in point, we had an aide that went in and the doctor said, you need to have a blood test. She went and had the blood test and got a bill for $1,000. And she came to me and she goes, I don't think that's right. I said, did you ask any questions? No, my doctor said so. I said, well, that's what I'm talking about, proactive. You need to say, why am I having this? Why are you requiring this whole list of stuff? Because I said, there's things insurance does pay for and things insurance does not pay for, whatever the case. Now, my second thing is, zero is great, if we don't raise the rates or do anything like that, but here's how and retirees are going to be here, people with dependents are going to be here today and in 5 years. But here's the thing, I think if we do little here, it's not a shock when you do, unless you have to do big up here, then, people will say, well, yeah, but you knew this was coming, you knew, why didn't you do something here? Now we're getting charged all this, or the district, and our rates are going up. So that's kind of like where I'm at with it. I agree, I'm going to be one soon, but I won't have district health insurance. And it's going to affect everybody's pocketbooks, and that's, I don't know. We're never going to get out of doing that, affecting somebody's pocketbook, I don't think.
I would say that the other thing that's hard for me, going back to my members, is how do you justify increasing when you've been building up, now you're up to 35 million from 17 million, and we all understand, we want a rainy day fund, we want to make sure, because we are paying the bills, and if you had 15 or 20 catastrophic cases in a year, it would hit that fund really heavily. However, those are anomaly years. The reason why we had that year where we had so many, that it was so high, was because we had 3 years, I think, with large claims just year after year after year. And that was one of the reasons why we got hit so hard. And that was one of the reasons why I argued for a lower rate increase than was being recommended both by Lloyd and LP Insurance as well as the district. And that's why because I was saying these are anomaly years, it's not going to continue like this. And, you know, they're like, yeah, but the checking account needs to be covered. And so we went with a lower rate based on our recommendation as a committee to the trustees. Had we been wrong as a committee, it would have been, you know, really a hard year the next year, because we would have had to raise rates. I'm comfortable. If Lloyd is comfortable and leadership is comfortable with 0%, I'm comfortable with that, because again, I don't want to go back to my members and say, yeah, we got $35 million built up, but we still think on top of the inflation you're experiencing and everything else, we're going to increase 1 or 2%. So I think going one more year, I'm not overly concerned with, you know, but we would have, next year, we probably will end up with 2 or 3%.
Can I ask a
So,
question on that? Go ahead.
Can I just expand really
Yeah.
quickly, because I think what you're saying is super important. We're not kicking 6.4% down the road, right? What we're doing is we're saying we think we have enough in savings to buy out this year. We're buying out this increase. And then next year, we look at the same analysis, right? So I don't want anyone to walk away thinking, well, we're just kicking the can down the road and it's going to have to be 13% next year. If we have hundreds of catastrophic claims, it could still be 13%. But what we're doing is using our savings to buy this increase for our members and not pass it on to them.
Has a document ever been created that maybe kind of outlines some guidelines for the fund balance? For example, you know, hey, if we're over 30 million, we know we're running a surplus, doing well. I'm making stuff up. But if you were like 20 to 30 million, we're feeling comfortable. If it hits 20 million, we're like, hey, this red flag, like some sort of parameters that we could even reference for a 0 rate increase this year.
So I think in our fund balance board policy, we recommend that the fund balance of this fund is about 16%, or cover 2 months of expenses. Off the top of my head, I don't know what that equates to in dollars, but we don't have any, you know, we work on percentages for fund balance, not dollar amounts, because someday, I hope not, that 30 million could be 10%, right? It just, it just depends on where we're at on total dollars of expenditures. Excuse me, but I do think, you know, after the last 2 years that we've had of significant surpluses, that this is a good use of those dollars to help offset this rate increase, and then look at it again in the future once hopefully we've had a full year of normal cost again, and then go from there.
I mean, I wonder if there could be some established policy around having X amount of months in reserve, and then if anytime there's more, we just know it's going to help absorb the cost. Maybe that could be more of a long-standing decision maker.
Yes, so I think that is a good idea. One of the difficulties of that is we never know what tomorrow brings, and we were, I believe, in the single digits of fund balance in this fund, 5 years ago, 6 years ago, and we had some 3 years of $5 million, so $15 million total came in from the OPEB trust fund that really saved the fund, in addition to rate increases, I think upwards of 10% for at least one of those years. But before that, we also had some really, really good years. So this fund is one that's bounced all over the place, and it's just, again, we don't know what tomorrow brings, and it's a tough fund to predict. I'll leave it at that.
I think the thing that I would say is, if we do start to experience surpluses over a period of time, which has not been our trend, that makes a ton of sense, right? Because then you want to be a little bit more strategic about year over year how you're making decisions, right? And is it kind of getting you where you want to go long term? I think having a lack of information is probably a function of having a lack of money most of the time.
Well, I think even to go back to your unit and to be able to say, we only have 2 months in reserves, we have to have a premium increase, unfortunately, right? That's easier to swallow than somebody just saying, we're having a premium increase, period. So maybe just to have some, you know what I'm saying, but just to have some guidance on, you know, this amount kind of guides these decisions versus this amount, these decisions. Might be some meaningful work we could do down the road.
I think it's kind of difficult to read that specifically, only because, like I said, going back to our history with it, having an operational budget between 17 and 25 million, being nearly fully staffed and being comfortable with that budget, now having such a surplus, not fully staffed, I mean, you know, what standard is going to reach that? You know, is it our staffing levels? Is it the monetary value? And then the general health of that population. It's nearly impossible to say, you know, how healthy you're going to be next year. We have no idea. You know, so I'm not saying I'm opposed to it, but I'm just saying it's going to be really difficult to find the magic parameters to say that this is how much we should have in reserve, et cetera.
And I would say that part of the reason why our fund, you know, we're not taking in the revenue because we're down 100 members from last year. And so that monthly premium that would be paid in by the district is not being paid in for those 100 members. And if you look at the number of openings we have in the district right now, if they were all full and we were fully, you know, to capacity with our employees, that money would be going in there. And typically, not always, and this has changed over the years as well, but typically when you're hiring new teachers and new staff, many of them are younger, have fewer health concerns as compared to older teachers who are retiring and whatever. So you keep that balance going over the course of over year after year after year through that. And we've seen, you know, the premiums decrease. And I think that some of this is because of premium decreases as well. And hopefully, you know, our HR is doing a lot of recruiting, so that'll be fixed, right?
I was gonna say, geez, Robert, that's a lot of digs at HR there. No, I'm just joking. I'm just joking. No, nobody knows more about the vacancies than me.
Unless you're in transportation, then everybody knows.
That's the truth.
Just real quick too, Mike, I was going to suggest, as far as awareness goes, I know that I've sent a lot of information out through our wellness ambassadors. Is that right? Is that the title? And that we found useful. Of course, my unit is incredibly small, so that was relatively easy. Might be different for yours. But sending out the information through the wellness ambassadors was really pretty helpful too. I know we went through like a mini campaign to reduce our use of the ER system, because I know that was a severe cost for a little while, and we were like, stop doing that. And it was the ER, it was something about the ER and the urgent care, thank you. So reduction of urgent care. And I know that through the wellness ambassadors, we were able to talk to our unit and just say, hey, cut that out as a practice, because it was convenient, it was simple, but it was costing us incredibly on our side, on the balance sheet side. And so we were able to reduce that at least to a fair degree. So you may have some, you know, as an established practice there, you might want to reach out through your wellness ambassadors or establish more of them and pass that information through them.
And I think now that we have Anthem, we have more care providers because people have more choices. There for a while, part of that going to urgent care was people couldn't get into doctors. It wasn't really urgent necessarily, but urgent cares love to say, we'll do primary care stuff and just come on in. But again, and they're on the list, but the cost of the plan was 3-4 times, or probably even more than that, to the plan. So educating people, we have had campaigns, but we need to continually do that. Jeff?
Okay, I'll add to that, because I just have lots of information tonight. I'm free till 7. Are you good for a while, Lloyd?
You can go have a beer afterwards, so just solve all the problems, right?
You know, just to tackle that one real quick, at a school site, anything that's sent out in a newsletter form, an email form, sign up for this, that, gets minimally met because people are overwhelmed, right? So really the only window you have to distribute a lot of information fast is at a meeting. So you look at like a school site, you got August coming up. I could see me justifying with principals, take 10 minutes during your welcome back day and talk about insurance, because quite frankly, insurance affects every person. But if you could just have a quick 10-minute presentation of boom, this is what it means to be self-insured. Here's some highlights. This is what we spent. These are the claims. And give them 10 minutes of information just to get everybody's brain rolling and generate some questions, then kick that down the road and let them go ask the questions. But I think we do need a forum that's outside email, contact risk management, because we have all these great resources, but people are just simply overwhelmed in their day-to-day work. So if we, and I'd be happy to help with that, but I also think it would be a reasonable request to say, can you do this 10-minute presentations for the benefit of our whole organization? I think that's an easy buy-in.
You know, like transportation, we have our meeting in August, all 300 employees are, well, excuse me, there's not 300 now, but anyway.
Yeah, you need a 10-minute, yeah, you need a 10-minute presentation.
We're all there in one spot, in one space, everybody can.
Yes.
I would like to pipe in on that really quickly. In the last 10 years, we've tried to get into transportation and the secretaries' meetings and the principals' meetings, and as you know, there's very little space to get in, and so it's rare that we can. So we are happy to go out to any site and promote anything for this committee. We just need maybe a little bit of help on getting on that agenda.
Well, we have new leadership now in transportation.
Perfect.
So
Okay.
Maybe my feeling's wrong, I think it'll be better.
Okay.
Because they're more open, they're younger set, you know, I should say this, but old guard is gone.
Sure.
And I'm not saying anything was wrong, but you get set in certain things and you don't really want to change, it's hard and stuff like this. That's all I'm saying about that. Now we have younger people coming in as management, more open to listen to ideas and things like this. I don't see why Scotland would not take 10
Right.
minutes for, you know.
We're happy to go there.
Yeah, and I think some of the challenge too has just been demand, right? Every department wants to cover 10 minutes, and then you've got Mike going, I have 7,000 minutes of content. What do I do?
I understand, but I think this could be moved up in the priority list, and I can help with that messaging, for sure. Oh, yeah.
Okay, this is fabulous conversation, and I know Mike wants to be here till 7 o'clock, but I am asking that we table logistics of how we message and address the item before us as to what are we looking at for a percentage increase or a maintenance at zero. And I'm hearing a lot of support for zero. Personally, absolutely. If we can do anything to take stress off of our members, I think we need to put some serious thought behind that.
Is there a motion in that?
Yes, I motion that we approve a 0% increase for next year.
Do I hear
Eric
a
Diamond, second.
It's been moved and seconded, thank you, Rachel and Eric, to move forward with a 0% increase, or recommend a 0% increase for the next 23-24 school year? Is that 22-23 school, the year 23, because it's fiscal years.
Yeah, for the calendar year.
Calendar year.
2023.
Just want to make sure I get this right. The calendar year 2023, a 0% increase to premiums. Is there any, fumbled through that. Is there any discussion? Hearing none. All in favor, please say aye.
Aye.
Opposed, nay? None? Okay, thank you. Motion carries.
Nice work, everyone.
Thank you. Okay. Okay. 2.06, presentation and discussion of possible new products and services provided by Anthem for the plan year 2023, including live health online behavior health services, diabetes prevention program, emotional well-being support tool, and virtual primary care. Possible action to elect any or all of the new services and programs to begin plan year 2023. It's a possible action item, and I assume Anthem is presenting?
Yeah, this is Laura Thurston for the record. Sorry, Kelly, you're there, right?
No
yeah,
worries.
I heard you.
Yep,
Sorry.
I'm here.
I was talking over you. But just real quickly before Kelly starts, so these are additional services or benefits, you could call them, that would potentially have more of a nominal effect on the, or a lower effect on the fund if we choose to have them. So take it away, Kelly.
Perfect. Thank you so much, Kelly DeBork from Anthem for the record. I'm so glad I get to follow such great news with some hopefully additionally equal good news here. So if you want to go to the next slide, I did put a quick agenda together for the programs. As mentioned, virtual primary care, live health online, diabetes prevention, and emotional well-being resource. So you can go to the next slide. The way I'll tee this up is really quickly give a brief overview of the benefit and program offering that would be available starting January 1st, 2023. And then I do have some cost information included as well. So the first benefit that would be an opportunity for Washoe County School District to roll out for your employees is an enhancement in our digital technology by adding virtual primary care. Please go to the next slide. So what this does is this gives an additional network of doctors for members to access via virtual care through the Sydney application. So this program there's no implementation to it. All you do is you tell me that you want it and we turn it on. And this gives folks access to a couple of different things. It is a comprehensive primary care portal and platform powered by Sydney, and it's a specific network of doctors that are contracted with Anthem. And you can see on the screen here, there are virtual primary care, chat with a doctor, and symptom checker. So by turning this program on, benefit to members would be they have the ability to do a free symptom checker, go in, they have a sore throat, they have a headache, they go through all of their symptoms, and it assesses where they are likely at in terms of a diagnosis and some opportunities for them to seek care, whether that's a recommendation of going to the ER, to the emergency or to the urgent care, or some lower cost options of telehealth. One of those being chat with a doctor. So this benefit would actually add text with a doctor. You are physically able to text on your phone with a board certified physician, your symptoms, what's going on, and they can treat you for urgent care issues and prescribe medications to you. So that's one component of this virtual primary care is text with a doctor. The other piece is virtual primary care. There are two pieces to that. And if you actually want to go to the next slide here, and you can skip that one. We'll go to number 6. So virtual primary care is actually comprehensive wellness and condition management. So today I have asthma and I go see my regular asthma doctor. I could actually transition that care and have a care plan set up with a virtual doctor if I didn't want to go into a physical location. They can manage blood pressure, diabetes. You can see the different diagnoses and conditions that can be managed via this virtual primary care platform. Let me caveat this and say, this is not to replace the care with your regular doctors. This will not be a fit for everybody on your plan, but this is definitely sort of the next step in where we're seeing healthcare go. More and more people have, through the pandemic, gotten groceries delivered, have gotten other things done from the comfort of their home, and being able to seek care and have a managed care plan is one of them. And that's really, this is really Anthem's response to that need. So you'll see here that there's also preventive care and wellness check-ins. This platform allows an individual to do their comprehensive wellness exam through the platform. There would be lab referral to an in-network lab to go get your blood work drawn. It's all updated and loaded into electronic medical records. And then you can have that conversation with your doctor on your blood work, anything else that's going on as well. So that is the virtual primary care piece of it. I'll pause here in just a second for questions, but the next piece, if you go to the next slide, is virtual urgent care. So this works really similarly to what you have today with Live Health Online. It's just using the Sydney platform and this virtual primary care network. Again, this is for urgent care services, cold, flu, strep throat. You can again see the list of conditions listed here. This would be on demand. No appointments are necessary. For the virtual primary care that I just covered, we do require appointments, but those can be made online and you can generally be seen same day. So let me pause there on just general questions on virtual primary care and what that might look like for Washoe County School District and its members.
Go ahead, Rachel.
I haven't gone through all the slides, but is there a cost structure comparison to, say, in-person primary care?
Yep.
Okay. Thank you.
Yeah, so not necessarily compared to the in-person, but if you want to go, Veronica, to slide, let's just jump around to slide 11. Let's just talk through the costs. So text with a doctor, if you're doing just the text visit, it would be $0 on the PPO plan, and it would be a $39 charge on the high deductible health plan until that deductible has been met, and then it would be no cost. For the virtual visit, whether that's the care plan, because you're doing diabetes maintenance and management, or you're doing an urgent care visit through this platform, again, $0 on the high deduct or on the PPO, and $39 on the high deductible. Again, once deductible has been met, it's $0. For the preventive service, it's free on both plans because it would be considered preventive under ACA. If you look below that on the Washoe County School District's costs, the $39 is the billed amount on the PPO. And then for the preventive visit, that's $100 billed to the plan. So on average, a preventive visit billed through the plan is about $150 to $175, just depending on the doctors. So there is a savings associated by going through this platform and having those virtual visits done via virtual primary care. So there is, it is less expensive on that. And then for ongoing maintenance of asthma, diabetes, etc., those costs are generally over $170 to $200 when you're seeing doctors for those sorts of care plans. So we do expect a savings. Again, this isn't going to be a fit for everybody, but just another avenue and opportunity for folks to access care that they may need.
Okay, I have one more question.
Sure.
So as we're looking at calling this primary care, does that mean that a person would mostly meet with the same doctor? Or are we talking a team that you would meet with as you get your appointment?
The latter, a team. Yep.
Okay.
So it would be based on appointment availability. However, all of the doctors use the same electronic medical records. So the nice thing about this is they're going to see all the history. They actually take the time beforehand to see what was discussed on your previous call. Where are you at? Maybe it's talking about blood sugar. So it's not retelling and resetting every single time that you use this service. Great questions.
During your presentation, you were saying that this is not to be used as a replacement of a primary care. Is that right? Or in conjunction with?
Some people, some people will use this as their primary care going forward. But we understand that some folks have a relationship with an existing primary care. We wouldn't expect them to use this service as a replacement for that primary care. Most likely, if folks have a primary care, they will likely stay with that doctor. You may get some shift of folks to say, you know what, I really don't like going in. I would love to be able to do this from home or from work. So this will just give them that avenue. What we don't expect to see on that is duplicative care. So in this program, if you're seeing a virtual primary care, let's say you're going in and you're having some joint issues, they can actually make referrals and help you find in-network specialists for, an osteo or what you might need there. So there is some referral help that they can provide as well. But that is a service that's built out into this program too.
Okay, so just as a follow-up question, from your position, who is the ideal customer for this service?
The folks that are just graduating and coming into the workforce would be my initial reaction. I think of millennials and Gen Zers that are coming into the workforce and making a very large generalization here, but they're the ones that want everything on an app. They don't want to pick up the phone. They don't want to call people. They don't physically want to go to a lot of places. I also think of this as working parents, those that maybe can't get away from work. Maybe they can't get childcare. This gives them an opportunity to be able to utilize services, get routine care in a really convenient, accessible way for them as well.
Okay, and then and I appreciate that. Thank you for the answer. And so it can be used as a general practitioner purpose. What is this comparison to cost to Live Health?
Yep. So Live Health Online is $59 as far as a billed charge on the back end. I believe you guys have a specific cost structure in terms of the cost share for an employee, but from the district's perspective, it's a $59 charge for Live Health Online services. So about $20 less.
Thank you.
Yep.
And I will say that I've used in the past, like Doctors on Demand and stuff before we had Live Health. And I know there's so many times for teachers, we're stuck at school. We need to be seen by a doctor, and you call and they say, oh, we can get you in today, but it has to be at 10 a.m. And you're like, really? How about 4 to 5? And I know you close at 5, but, and so having an option, and even honestly knowing our market with primary care physicians, I'm not tied to my primary care physician. He retired during COVID, and they've changed my my PA twice since then, and it's only been 8 months. So I think that giving people an option to be able to call in or text or have an online relationship, be able to get things, because most of the time I go in, they check my blood pressure. It's boom, 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 and it's nothing major, and I already know what I need, and they know what I need. So I just think this is a great opportunity for our members.
Fantastic. And just to add from a cost, as we're talking about that, the nice thing about this program as well is there's no additional per member per month cost. There's not like an administrative fee that we would add on as a part of the services. Again, it's just the claim cost that happens as an individual utilizes services.
Question. So this is Rachel Drake again. So if we were to pick this up, we're also then considering dropping Live Health. There isn't a benefit to keeping both?
Live Health would remain. So let's actually jump into Live Health Online. I'm talking a little bit about behavioral health, but so Live Health Online would remain in place as well. So folks could still use that for virtual urgent care visits. Right now, with this virtual primary care option, this is only available for individuals 18 years of age and older. So there's not a pediatric component to it yet, nor is there a behavioral health component to it yet. So Live Health Online also remains because there's pediatric care available through the Live Health Online. We would want to keep that for those virtual visits for those sick kiddos when parents can't get away and want to use that. The other piece, and what we're also talking about, if you want to go to slide 12, Veronica, is the Live Health Online behavioral. So today, Washoe County School District has the medical services that folks can use through Live Health Online. Live Health Online also does psychology and psychiatry. So there is a whole behavioral health component where we have clinical professionals that can address specific mental and behavioral health issues as well. So that is another program that we wanted to present as an opportunity to be able to add the behavioral health component to the Live Health Online offering you have today. So I just want to make sure, Rachel, that answers your question. Live Health Online remains the same.
Yeah.
Any additional questions on virtual primary care or additional discussion?
Not seeing any. Thank you.
Okay, perfect. And we can always circle back. And I think too, Laura, there's a lot of information here today. We can certainly kind of breeze through it. You guys can have time to digest the slides, and then certainly can present again in July or June, if necessary, if there are additional questions, because we still have some time on making decisions on our end on this. So just wanted to tee that up as well.
Quick question.
Go ahead.
Just a quick question. Would this be something that we would roll out in January with the new plan, or is this something that would be in effect as soon as it's adopted?
January. So this would all coincide with renewal. Perfect. So if we want to move to the next slide, I don't think any of us needs a reminder in terms of the behavioral health crisis that we're in. I actually would argue that these stats are a little bit old. 1 in 5 adults reported that they did not get the mental health support that they need. I would argue it's probably more like 1 in 3 now. 85% of employees' mental health conditions go undiagnosed or untreated. So really, Anthem's answer with Live Health Online was to partner with them to provide behavioral health services in a virtual environment to allow better access and quicker access for folks that need that in real time. You can go to the next slide. I actually included this. This is Washoe County School District's actual behavioral health details. So there's a couple of things on here that I wanted to point out. 21% of the members that have that had a behavioral health claim in 2021 were not engaged with a primary care physician. So we presented, virtual primary care first, and now talking a little bit about behavioral health. But we know that people are on better treatment plans if they have a primary care who can help refer them to the appropriate specialist. The other thing that I want to point out here for you all is the 47% of members that have a behavioral health diagnosis also have another chronic condition. And the one I highlighted is low back pain. This is pretty much what I see across all of my groups. But you can see low back pain. Those that have low back pain, we have a very large portion that have also been diagnosed with anxiety, shaded in the gray, and depression, shaded in the light blue, as well as substance use disorder in the darker blue. So just showing you that both the mental and the physical health really, really go hand in hand. We understand that. We know that there's not enough providers, that people have access issues. So again, this is just really something to expand the ability for folks to get the care that they need when they need it. So if you want to go to the next slide. This is really how Live Health Online behavioral health can help. So on average, Live Health Online psychology is about a 7-day turnaround for the first visit, whereas if you were trying to find that in the community, it's on average 26 days. And again, I would argue that's probably even on the quick side. And then psychiatry, it's 28 days. So this allows continuity of care between online visits and allows doctors and therapists to refer members for additional support. So if you're seeing a provider via Live Health Online, they can help you with finding local in-network doctors as well. This gives you self-scheduling opportunities 7 days a week, which is huge because many practices are not open on weekends. It's available in all 50 states, and it's accessible the same way you're doing Live Health Online today via smartphone, tablet, or computer. There is multi-video as well for couples or family therapy sessions, which is something that can be done via Live Health Online behavioral. Any questions on this piece?
I have a quick question. You said it's
Sure.
available in all 50 states, and I know in the summertime a lot of teachers, and certainly I'm traveling, and I've used years ago Doctors on Demand when I was traveling when I got bronchitis. So that's a really great thing. And I assume because it's available in all 50 states that they can also get your prescriptions filled if you're in another state and they prescribe something, right?
Exactly right. Yep. Perfect. You want to go to the next slide? And actually, I'm going to skip the next one. If you want to go to the next one, Veronica, sorry for making you jump around. Really quickly, commonly treated conditions that are available through the Live Health Online behavioral, bipolar, panic attacks, anxiety, depression, stress. All of those are conditions that can be discussed with through the Live Health Online behavioral health app as well. If you want to go to the next one, actually skip the next one and go to the one after. This will hit on Robert's, just his comment. Prescriptions. So these psychiatrists do have the ability to prescribe. Obviously, they will not prescribe any controlled substances. You can see those that we cannot prescribe via telemedicine and that blue circle on the bottom right. But the common non-controlled prescriptions include all that list there in the middle with the bullets. So just as you mentioned, Robert, do have the ability to do maintenance medication and fills as well through this program. And then next slide. Again, I think it's more impactful when we see the data specific to ourselves and our population. The big number that jumps out here is the one on the left. This is, again, Washoe. This is comparing from 2020 to 2021. We saw a almost 38% increase in our behavioral health per member per month spend. So more people are going, more people have more things that they need help with from a behavioral health perspective. The top conditions by spend, depression, anxiety, and adjustment disorder, those are generally the top 3 we see across all of our groups. And then just below that, you can see the professional outpatient. We've had a 23% increase in outpatient visits per 1,000. So folks that are accessing care with their doctors, because today you can, see your doctor both in person, and many of our contracted behavioral health therapists and providers do virtual visits as well. So that would be able to continue. This is just an additional resource that's available. If you want to go to the next slide. And let's talk really quickly about costs. So for the behavioral health through Live Health Online, those costs would match your current behavioral health copays today on your PPO plan. We can customize these, so we can change them if you'd like to. We just have to make sure that they match the medical office visit as well to make sure that we stay in parity. And then you can see the charged amounts for a psychology visit versus psychiatry visit. That's the billed amount. So that would be the billed amount back to the plan. That's pretty in line with what we would see on average from a regular doctor in the community. It might be just a little bit below $175 for an initial 45-minute assessment, and then $75 for the additional follow-ups if you're seeing a psychiatrist, and then psychology is the $80 or $95, depending on the length of the session. Any questions on Live Health Online Behavioral? All good?
No, I think we're good.
Awesome. Again, lots of stuff here. I know we are coming up here on the hour. I'm going to really quickly hit on the diabetes prevention program if you want to go to the next page. This is a digital diabetes prevention program that would be available again for Washoe members starting January 1st. This really is identifying the pre-diabetic population, so those that are at risk with abnormal blood sugars, and working with them to identify actionable items that they can do to lower weight, improve blood sugar, and really the end goal is preventing full-fledged diabetes. So this is really identifying the type 2 diabetics. I did get some specific Washoe data as well. If you want to go to the next slide, Veronica. Based on claims information, there are roughly 190 Washoe members that have been identified as pre-diabetic. So this is not a huge subset of the population this would have an impact for, but it definitely has a large impact on those individuals in preventing them from moving from, pre-diabetic into diabetes. So diabetes has doubled over the last 5 years. It affects more than 10% of our adult population. Just some statistics here on this, and you can see the annual cost of diabetes is $327 billion, which is just absolutely crazy. So we know how expensive it is. If you want to go to the next slide. So what this program is doing is it's actually reducing the risk of type 2 diabetes by 58% when we look at our control studies. So it's had a really significant effect. If you want to go to the next page, what this program does, it is recognized by the CDC. It is considered a preventive program, so there's no member cost for this. And what somebody would do is once if they think that they have prediabetes or they've been told that they do, they would take an assessment, an online assessment. If they qualify for the program, they are actually put into this 26-week preventive program. They get weight coaching facilitated. They get a wireless scale sent to their home. They get nutrition therapy, daily check-ins from a coach. They get guidance on sleep, activity, behavioral health screenings and coaching, and everything is done via a virtual app powered by Lark Mobile. So that's the back-end engine that powers this, and this is for eligible participants 18 years of age and older. If you want to go to the next slide, and actually you can skip the next one and go to 27. So with the Lark Diabetes Prevention Program, there's sort of two pieces. There's the actual program itself that an individual can go through that has the no cost benefit. And then if you wanted to, we can actually bolt on an outreach program. Basically that allows us with the claims information is to send communications to members that could qualify for this program. I know we've talked a lot about people don't read things, they don't hear, they don't pay attention. Part of the challenge is just getting people to know that they have these programs available. And with the outreach program itself, we do target members, we do mailings. It is 3 campaigns a year. If you want to go to the next slide, and we reach out to the members that are most at risk of progressing into type 2 diabetes. It's email notifications, and then it helps folks understand that the program is available. And by doing the outreach program, it actually adds a little program tile in the Sydney application where folks could just go into it and see, oh, I have this program, I didn't know that, and go through the questionnaire to determine if it's something that they qualify for. So the next few slides basically have some screenshots that show what's included if an employee does qualify. It talks through how they progress through the app through Sydney. It's single sign-on. You can go to the next slide there, Veronica. And then, again, all a digital. Everything probably looks pretty similar to a health risk assessment you take through your Virgin Pulse. Answer a few questions, and then next slide, it'll tell you if you do qualify as pre-diabetic and get you signed up and moving to get that scale sent directly to your house and signed up for the Lark program with a diabetes educator. So go to the next slide for me. This has kind of the milestones and what's included. It's the wireless scale and then the engagement in the program. And the goal is 5% or greater weight loss from the start date within a year. That's the program outcome that they're searching for. And if you want to go to slide 34. Again, no per member per month fees, so there's no additional administrative cost for this. There are 4 milestones that an individual would go through throughout the year. The total billed amount for that would be $372. That would be what Washoe would see as far as a billed claim for an individual that goes through the entire program and completes it. There's no member cost regardless of high deductible health plan or PPO because it is considered ACA preventive. So there's no member cost share on that, which is fantastic for a member. So that's the meat of that one. Let me pause there. If you want to go, Veronica, to slide 36, this just summarizes again the costs of that, and I will pause if there are any questions.
No questions.
Great. Awesome. And again, happy to come back. I know this is a lot of information. You guys had a lot of dialogue already, so I know it's end of the evening. The last program is actually a benefit that's already in place today. We just wanted to give you guys sort of a notification and an update on this. This program is called Emotional Wellbeing Resource, or Learn to Live. This is actually has replaced an old program that your members had access to since they came on with Anthem in 2020. This is, if you want to go to the next slide, this is a self-guided digital behavioral therapy program. It's an online program that allows self-assessments and recommendations to employees and their families to help promote skill building, resiliency, mindfulness. And the program itself allows an individual to select the topic that they would like to work on. Let's say it's mindfulness. Maybe it's anxiety, depression. It is a engagement program that they do via their phone that allows them to work with master's level clinicians. They can text with coaches, they can email, they can get additional phone support. There are additional peer-to-peer communities that help encourage social support. And then there's mindfulness moments. People can sign up for text messages throughout the day to remind them to stop what they're doing and walk around or take a breath and all of the things. So it's really just sort of, I would say, kind of that dipping that toe into mental health and behavioral health. Maybe folks that are struggling with some things don't feel like they need to see somebody in person, but they want some self-service and some additional support programs to help them, stay in the moment and be present. And this is really the tool that's available. So again, there's no cost to this. This is no cost to the plan. There's no cost to the member. And this is a benefit that is out there that we just wanted to let you know. It did just get rebranded and refreshed this year. So we're just bringing it to your attention to let you know that this is a great place that you can refer folks to as an opportunity for them to continue to promote, positive mental health, in a way that works for them. So that's it. I'm 3 minutes over, 7:03. I know I talked fast.
Any questions? Eric Diamond.
So there was a portion of your presentation about identifying at-risk employees of ours. Where's that information coming from? Is that from our annual health assessment? Is that our Virgin Pulse information? How is the Sydney Health Program determining eligibility or at-risk members?
Yep, so this is all going to be based on claims data. So when you go into the doctor, when you get a glucose test during your annual wellness visit with your doctor, it's all going to be based on claims information that gets submitted to us.
Okay, and a different question here. This is, Live Health is totally independent from Sydney Health, but offers similar functions. Is that right?
Correct.
Is there an information sharing that goes on between Live Health and Sydney Health? For instance, if one of our members felt sick and went to Live Health and then engaged Sydney Health for almost the same issue, resulting in kind of like a double billing to the district, we'd pay $59 for Live Health and pay a different fee for Sydney Health on the same issue if the member were to engage both of those?
Yes, you would be billed for both. One thing that I didn't specify on that virtual primary care, so if they use more of the Sydney route, if I use it for an urgent care issue, let's say I'm having vertigo, let's just use that as an example, and I have my visit, the plan is billed $39. If I have the same symptom or the same issue within a 7-day window and I engage again in that Sydney Avenue with virtual primary care, the plan is not billed again. So you have a 7-day sort of grace period, if you will. If you need a follow-up question, if you're still having symptoms, you need to sort of re-engage with that provider. You're not billed twice for that visit if it's within that 7 days.
That's excellent. Final question on that one, kind of the information sharing between Live Health and Sydney Health. Is there enough information shared that a member can't doctor shop between the two? For instance, if I want a narcotic or I realize there's a list of non-narcotics that you guys can't do. But for instance, if I was doctor shopping and tried to get a prescription from Live Health and then follow up with Sydney and try and get a second.
Yeah, generally there's going to be edits at the pharmacy that would be a refill too soon. Even if it's 2 separate scripts from doctors, the claim system is going to see that you just filled one and then you're trying to fill it again. It'll generally deny that claim as a refill too soon.
Very good. Thank you.
Mm-hmm. Great questions.
Jeff, go ahead.
Thank you. So Kelly, thank you for the presentation. I guess what I'm gathering from all this is that we just have more platform for members to access healthcare with a very minimal cost to the plan. I think that was just the $372 for the diabetes. Is that correct?
Yep, that's exactly how I would summarize it, is more access, more resources for folks, and trying to keep it as low cost for both member as well as for the plan.
Okay. Thank you very much.
And
Sure.
I would suspect that if people aren't going to urgent care for things, it's going to be a plan savings overall. Because I know a lot of people who use urgent care just because, because they can't get into their doctor.
Yep. That's exactly right. And average urgent care costs, and Lloyd, jump in and correct me if I'm wrong, I would say average urgent care is between $150 and $200 as far as a billed amount, depending on what you're seeing for.
Tony?
This is something that's always bugged me about many, many things. Why is it everything is based on Eastern Standard Time when we're on the West Coast? That really bugs me because things are, maybe I don't feel well at 5 o'clock in the afternoon. Well, sorry, but it's past 5 o'clock Eastern Standard Time, so I can't contact anybody.
Yeah, right now with virtual primary care, since that's just rolling out, this year for groups that are renewing right now, like in 7-1, my guess is they will, as the program and the services continue to be utilized, expand hours. That's just for the virtual primary care. Live Health Online is 24/7. So for those urgent care issues that you do need, Live Health Online is accessible for those physical health sort of things, 24 hours a day, 7 days a week. So obviously wouldn't want to get rid of Live Health Online because that's a huge add from an employee's perspective in that. But definitely appreciate the comment. I'm with you in terms of those hours of operation.
Thank you, Kelly.
Sure.
Other questions?
So, not a question, but comment. I appreciate that what we're discussing here is not adding another app and another thing that people have to go to, but being able to say there are more services available through what we are currently using. And I am absolutely thrilled to see the behavioral options and the a primary care option available for those folks that are comfortable doing it virtually. These are fabulous things I'm excited to see.
Great.
Eric?
Kind of general comment as well. I see thank you for your presentation. I see the overall benefit is eligible here. The one thing that I just wanted to add to the general conversation is that we have a lot of services available. And it seems that some of these, and many of them, overlap each other and have the potential to cost us to some degree. Maybe not greatly, but I consider myself to be relatively tech savvy and keep up with the time, so to speak, the apps, the online doctors, and all that kind of stuff. But I was just going through, and I just rechecked my own Sydney app and realized that I had like 15 messages I've never checked on there. So my general concern, or comment, let me just say my general comment might be that we're just aware of how many services and platforms we're offering. Because being on the insurance committee, I haven't engaged my Sydney app since we've opened this. And that's just me. There's 7,000 other members that we all represent, which doesn't, those other 7,000 members may engage it a whole lot more than I do. But just being aware of how many platforms we're engaging, what the potential costs are and whatnot, and making sure that we're actually having more utilization than just having every option available at minimal cost, and we'll just do this when they're overlapping in certain areas.
I think that goes back to educating people. And I would say also that with a diverse population, some people are going to feel more comfortable going to a doctor. Some people are going to feel, I think that just having more options for people, some of them being cost savings certainly, but, is a good thing, for people to be able to choose what's comfortable for them.
Absolutely. And just again, some, real metrics for you all. You average about 1,000 visits into Sydney every month. Just so you guys have some idea of kind of where you're at in terms of how your folks are accessing. That's just the Sydney app. So that's not anthem.com. So about 1,000 a month of visits that people are logging in, just so you have some data on that.
Thank you for that.
Sure.
Jeff?
I'm ready to make a motion. That's all right. Excuse me. I move that we elect all of the new services and programs that we just received in the presentation to begin plan year 2023.
Is there a second?
Rachel Drake, I second that.
Okay, Jeff moved and Rachel seconded the motion. Any discussion? Okay, all in favor of the motion, please say aye.
Aye.
Aye. Those opposed, please say nay.
The air time is an aye for yes. Sorry, I didn't say.
Okay, so it's unanimous ayes. Have it. Okay, thank you. Motion passes.
If I may, before we let our representative go, can I ask one final question?
Sure.
Too, actually.
Sure.
Is there any repercussions to having this repealed, removed, or stopped?
No, not from the way that Anthem sees it. All the virtual care is approved in all 50 states. So no, from our perspective, do not see that walking back.
Okay, thank you.
Thank you so much for your presentation. We really appreciate that. And okay, no other questions. We'll move to the next item, 2.07. Presentation, discussion, and possible action to change Washoe County School District Group Insurance 90-day benefit waiting period for new employees. This has been on here every month. Go ahead.
Okay. Laura Thurston for the record. Mike said that he has until 7, so No, I'm just kidding. I'll make it quick. I'll make it quick. But I did want to give everyone an update. I've had continuing discussions with HR and the business department on this subject as well. As you know, we've been working towards more efficient technology when it comes to processing our actual our benefit period, and we're still working on that. So we've looked at that. We've looked at the most likely $1 million general fund impact that this would be if we made a change. The unknown impact that would go to our health insurance fund, just because we're uncertain of what claims would be there. We don't necessarily have a crystal ball on that. We've looked at kind of comparison to other public entities, which we are currently in line with Washoe County and City of Reno in terms of a 90-day waiting period. But we're not necessarily in line with some of the other school districts in our area. That being said, we're not in the position right now where we feel as we can support a recommendation to make a current change to the 90-day wait at this time. So certainly, we're not dropping our tech piece at all. We're still moving forward. And I've had several conversations with Emily. Like I'm really on the bandwagon of really kind of moving our processes towards greater efficiency. So that's a piece of the puzzle. And I certainly can bring that back around. I think when we're ready, we're currently working on that every week. We have weekly meetings between our team and the IT team. Things are getting better. We're honestly, we're nowhere near being where we need to be for this upcoming school year for sure. I'm hopeful that it will happen, but realistically, I don't know, and I wouldn't feel comfortable saying that it would happen. That being said, I also don't know where we'll be, in 6 months or a year from now financially, if that will look different, if we will also have additional funding that we don't know of for this piece. And, it's also our belief that while it would add, I think, quite a bit to the benefit package as a whole, and it would look great, I don't know in terms of recruiting if that's the biggest piece right now. And Emily can probably speak to this better than I do, but I think that, the compensation piece is kind of a large piece, and that's why we're looking at trying to keep our rates lower right now, to keep, to kind of balance out the compensation piece with the inflation piece as well, that we're seeing. So, Emily, you want to add to that? Okay.
I would just add that we know that this is an important ask for the committee. And I think, hopefully in your experience with me, one of the things I always like to joke when employees are frustrated by something is, if I could say yes, I would, because then you wouldn't be mad anymore, right? So if there was an opportunity for us to make this happen, cost is one consideration, of course, but from an operational perspective, we just aren't in a position to do this well right now. And our existing processes are so inefficient. Short of begging you to come shadow our benefits techs to see what our processes look like, I'm imploring you that we're not giving lip service to the lack of technology that really prevents us from making this change right now. Cost aside, right? We know we just approved a 0% rate increase, and moving forward with this recommendation would incur an additional cost that, would need to be considered. But operationally, this is not a lift that we can do right now, especially during what is now our busiest period, ramping up for the upcoming school year. So I just wanted to share that perspective.
I just have a quick question. I say that every time. It's not always quick. But really, honestly, so what, I know you're trying to go to an online, stuff, moving this online. But technology-wise, if Clark County with a much, much larger district can do, are they at 30 days or were they just the next full month? I think they're at the next full month that you work. So it's not even 30 days. You get hired on the 28th, next month you're covered. Have we looked and are we looking at different types of technology that we might be able to implement in the very near future to, and I know there's a cost to that to the district, but certainly we need to move into the 21st century and our HR, we got out of SASE, we've gotten away from GroupWise, now we need to move,
Away from DOS.
Yeah.
I think that's a really important question, and I'm glad that you asked it, because I think that while we're talking about technology from a benefits perspective, it is part of a larger technology conversation. And our human resources information system, Business Plus, it also manages a lot of our finance and that sort of thing, has absolutely reached the end of its useful life for us as an organization. The processes, so it's kind of a hybrid between a product that other people can buy, and then it's been Frankenstein customized for us. And so we have put onto our capital improvement program, the 5-year CIP plan, the replacement of Business Plus. And as I hopefully am not speaking out of school, but I had my first one-to-one with Dr. Enfield during her last visit, and I shared with her, some of the woes of Business Plus and what it means to be in HR. And she also is familiar with Business Plus. They use it in Highline, and so she said, "Is it in the plan to replace? And what is the timeline? And can it be faster?" So, I think that we are reaching a critical mass, not just from this perspective, but I'll talk about principals, right? I'm working with our Principals Association to really evaluate the standalone principal job. And I just think about HR processes and what that adds to the day, right? And how meaningful it would be to have a system that processed electronic requisitions, for example, right? So that's a very, very long way of answering. Yes, it is becoming more and more imperative every day that we look at our HR systems as a whole. And so while Laura and her team have been working diligently to try and, kind of have a bridge solution for electronic enrollment, I think the need is much bigger than that.
Other questions, comments? Rachel.
So I want to shift the discussion just a little bit, because I certainly hear that right now we do not have the capacity to implement anything. But we also haven't decided on what we would like to implement for our members. So can we talk about what that might look like? I mean, are we talking because we currently have a system that says we have 90 days to 91st day of benefit. And that is the first day there. People are told they have the first 60 days to get their forms turned in. So if we are shifting to a 30-day system, which I really would like to see happen, what does that look like for form turn-in? Is that 15 days? What is the deadline for dependent sign-up on a 30-day system? So if we have a better idea of what we're trying to get to, I think we can have a better idea for when we need to, how we can roll it out.
I think what we're saying is that until we have an electronic process, we can't support, and it's not doable to try to turn our current paper process into a shortened process. We absolutely believe that we don't have the resources, people or technology-wise at the moment, to accelerate that timeline on paper.
Jeff?
Thank you. So Emily and Laura, thanks for that, your explanation of what's preventing us from moving down this road at this time. I think everyone here would like to eventually get to a place where we can shorten that period. Would it be appropriate to ask for an update, let's say in January, with any improvements in the process? And then, maybe what does it take to drop it to 60 days? What does it take to drop it to 30 days? From what more do we need on technology? What more do we need from staffing? And then there's a general fund cost component too. We have to take into consideration. So if we just have like an option plan or something, I think that would be useful. Help Rachel with what you're getting at, and just know what the consequences of those decisions are and what needs we need for each one of those changes.
Yeah, I think I would say that we could bring updates even more regularly, and I think that was some of the conversation that happened at the last meeting that I took part in this discussion. Again, this is not something that we are coming to talk to you about and then not doing anything about in between meetings. Laura and the IT team are aggressively trying to work on a solution. Whether we make a benefits change or not, right? The member experience right now still also requires this technology solution. So I think as we continue to talk about some of the things that we've talked about tonight, like education campaigns and the open enrollment process and that sort of thing, we can certainly bring periodic updates. I don't know that it makes sense to come every month, but perhaps every other month. And as we start to reach certain milestones and have a better understanding, for example, of what does going electronic do to processing time, because then that's going to current processing time, because that's then going to help us understand what people resources we would need to make this happen. I think that committing to providing regular updates is absolutely appropriate, and is really a continuation of the larger how do we make this whole package really beneficial for members.
And I think, obviously for the 23 year, where we're at, then, you're in the process of getting ready for that and gearing up, and that's not going to happen. But I think, for the 24 year, as Rachel was talking about, I think we do have to sort of set a goal of saying, by 24, we want to have a 60-day, and by 25, we want to have a 30-day, or we want to go with 30 days by this, I think we as a committee need to have a sense of this is what we're working toward, what we would like. We can't direct staff, but we can ask staff to work toward, and then, say as a committee, this is where we would like to see us going. And I think that's I think that's fair to staff, and I think that's fair to ultimately for trustees, because if the trustees know that this is something we're moving toward, it's $1 million cost, or 60 days would be what, half of that, $500,000, or maybe, I don't know, a third, maybe, I don't know. I'm not a mathematician, but ultimately, that's a budgetary issue that, certainly the CFO and leadership and the board have to look at as well. So, having them aware of the fact that we're saying, by 24, we'd like to see it 60 days, and by, 25, 30 days. And that gives over a year and a half for IT to start making changes and figuring out how do we do this? Do we need to do an RFP for a system change, whatever? It gives the board planning time to look at it, and if they decide to approve, our recommendation, how do we budget? How do they budget for that? So I think it's only fair, because if we're not having that conversation of where we would like to be, and we say, yeah, sometime, down the road, we'd really like to get to, well, really like to get to doesn't really say this is where we're working toward. So I think that it's just, maybe it's semantics, maybe it's just words, but I think we as a committee, I don't know that, we need to take action, but I think we really do need to make it clear. I think we're wanting to move forward toward this and really want to set sort of a goal down the road. Maybe that's just my reading of it.
I think that's fair, and I certainly, if I came across as saying I don't think we should set milestones, that's certainly not my intention. I think you make a great point in terms of how this cost increase gets considered in the rate conversation every year too, right? So if we are looking again at the potential for a 6.5% increase next year, and also you all know that this is a priority and it's going to be another $500,000 or $1 million, right? That helps you sort of think through, okay, what, you know, our priority is getting this timeline down, but now we have this increase that we're facing. So what kind of trade-off do we want to have? So I think those conversations absolutely have to happen in tandem. And again, neither of us are opposed to, you know, setting milestones or goals for when this could happen. I think, you know, we just really want to portray or convey that we want to do it well, and we don't feel like we're in a position to do it well right now. So.
And we really don't know what it's going to impact the plan people coming on might have. But we also know that that 500,000, if it's 60 days or $1 million or whatever it is going to be money that the district is going to be putting, you know, you say it's a cost to the district, and it is, certainly that they have to budget for. But where's that money going? It's going into the insurance plan, so it's going to be premiums that are paid into the plan. So ultimately, you know, there will be premiums to help cover that. And in fact, you know, it may not be as big a liability to the plan as one might think. It might be, but I don't think it would be.
Yeah, it is hard to predict what that claims activity will look like. Just keep in mind, right, that the general fund is where COLAs come from too. So that's kind of another one of those balancing of priorities. We don't have the opportunity to increase our revenue. We're at the mercy of the state. And so as we're trying to accomplish, you know, these different things for our employees, that's where some of the prioritization comes into play.
And maybe perhaps, you know, this is a question for Lloyd. You don't need to necessarily come up, but just, you know, to look at in the future is, you know, is there a way that we can get some data on Clark County or a similar type of plans that have that 30-day or less or 60-day or less, you know, utilization? Do they see a huge utilization in that first month? I mean, do we, after the 90 days, do we see those people who've come onto the plan for 90 days, do we see a huge utilization of those people as well, our new hires and whatever? So I just, so we could have some data surrounding, you know, that as well. Not that that would be predictive necessarily, but it might give us some idea.
So,
Not to be too intrusive on your meeting with Dr. Enfield, but what was your generalized time frame on rolling out something new?
So we didn't get that far into the weeds in that meeting, but I will say that from a district perspective, it's in the 5-year CIP, which I think we're now already almost through year 1 of the CIP, aren't we?
So the CIP that the board approved on April 12th, year 1 would be
this coming
FY23 that starts on July 1st.
Okay, perfect. So never mind, scratch that. So it's in the 5-year CIP. It was slated in year 5. If you just think about the magnitude of the implementation, moving it up from year 5, I would still guess that we would probably be 18 to 24 months out on a whole system implementation, because it covers our position control, so all of the allocations and who belongs where. It's our HRIS system, it's our payroll system. So going through the RFP process and trying to identify either a single or multiple solutions to come together to meet all of those needs, I think will be a bit of a longer process for implementation. Yeah.
okay, so I just want to note that Lloyd has been gracious with us and has several times answered the question on impact expected to the health account, and that impact would be minor. And I would also like to throw out some additional days. I am very strongly invested in seeing this move forward for our members, and really would like to see an addition to the presentation to the board for the 23 year of reduction of the benefit timeline. If we can't pull it off in August, what can we pull off in January? I'd really like to know how close we can get. Where can we start making a difference? And yes, the systems are awful, and I understand that very much as a teacher who is constantly asked to do more with less. I get that that's what you're telling us we're asking you to do. I understand that. I understand what a crazy thing that is to do. and I still think we need to do it.
I think, and I don't know for sure the mechanics here, but you might need to reconsider the rate conversation then, because there is a financial impact, not from a claims perspective, but from a premiums perspective. So,
Yeah, I think, I brought this up the first time I met you, months ago, whenever that was, is the first question I was asked by some principals, why do we have that 90-day wait here? Based on the current economic times, the inability to hire anybody, I would be curious if during this hiring season, we could ask people directly, did this impact your decision? Like, I don't know if you already do any type of onboarding survey or anything, or people that passed on us, but I agree we're making some big financial decisions. And initially during this conversation, I did think it was a budget neutral decision. I didn't realize it was going to be so cost heavy until Mark came and presented that. So I am beginning to wonder, does that really influence your overall decision to somebody taking a job locally or not? And I wonder if there's a way we could learn a little bit more about that.
I think that's a great idea. Let me talk to our HR technicians about some of our processes and where we could gather the most valuable data. I might need to lean on principals a little bit too from a hiring perspective, right? Because we don't always get information on who declines. And so we certainly can gather information on who accepts the job and sort of, what impact it has on their life having to wait that 90 days. But to be able to quantify, are we losing candidates because of it? Let me think about that a little bit. But yeah, that's an interesting question.
Lloyd? Oh, just real quick, just wanted to comment on that, Rachel, because you're correct. I have made that comment. I just want to make sure there's a clarification on my position on that. We wouldn't anticipate higher claims costs due to a pulling forward of the waiting period, but you do see a pulling forward of the expenses. So those expenses, whether it's premium on the revenue side of the equation, which is where you're saying there'd be a cost increase in a budget year, pulling those the claims would come forward as well. So again, depending upon how that rolls into the year, you're just going to have claims that would have happened 90 days out, happen 30 days out, or 45 days out. So just a bit of semantics there. Just want to make sure everyone's on the same page with that.
And I think in terms of kind of our thinking or concern about that too, I'm not as concerned about that. I am a little bit concerned about candidates potentially exploiting our leave policies if benefits go into effect on the first day. So some of our contracts, and it's a great benefit, right, have very, very liberal leave policies, and we already see a little bit of that happening with really, really long-term leaves. And so we have some waiver of premium provisions that you all might need to look at, just to make sure that there weren't any unintended consequences in that way. But that's kind of more what I think about than, all of a sudden we have large claims that just happen within that 30, or that first 90 days.
Eric?
I'd like to echo some of Rachel's comments that I too am very interested in keeping this on the agenda and moving it forward as much as possible. I see it as an incredibly important recruiting tool. Within my industry, we're being completely outclassed as far as the benefit in insurance. So within the police realm, it is impossible for us to even compete. So to bring this down as even just a remote potential to bring somebody in is incredibly important to me, even as small as we are. So I echo your ambition on moving this forward, and I want to make sure it's also done correctly. I don't want to do it, haphazardly or recklessly if we really can't follow up with what we're promising. Going as far as you were saying, can you clarify, was it 24 months? You said that you were not confident that up to 24 months it would be for implementation at its earliest?
That's a very rough guess, right? I mean, you're talking to an HR person, not an IT person. Do you want to hazard a guess? I just think about like RFP timeline, right? And then the scale of implementation in terms of whatever might be necessary for employees to go in and do new setup and that sort of thing. I feel like 24 months is a conservative estimate, but I don't want to, commit my firstborn or anything.
No,
And-
sure, no, I appreciate that.
Put,
No, I definitely want it. I'm ambitious. I'm following your ambition, Rachel, because I really do see this as an important component to what we can offer as a district. I do want it done right, so of course, we take your input in here very seriously. So, okay, well, let's do this right. I think by coming back and reinforcing that concept, that we definitely want to move forward on it and trying to meet with you all on a relatively consistent basis to ensure that and with respect, to ensure that is meeting what we're trying to do.
I want to just clarify too, when I'm talking about Business Plus, it does not mean that we are putting on hold the work that we're already doing for the online portal, right? The two tracks are happening simultaneously. I think at some point they will collide, but I don't want to say we're 24 months out on you all, being able to make that kind of decision or implementation, or that is contingent upon changing Business Plus, because Laura and the IT team are still doing work in the online portal, because that's still absolutely a critical component of being able to make this happen and make it happen well for members. And that's a substantial concern, right? I don't want to promise the next pay period or 30 days and then people don't have cards and dependents aren't set up in systems and claims are getting denied and all of that kind of stuff. So when you're sick, that's the worst time to have things go sideways. So I wanted to just clarify that Business Plus is not a change to Business Plus is not required in order to continue this conversation.
Diane?
This is so 30-day, 90-day stuff. It's not even funny because we're not getting the people and they're not staying if we do get the people. And what they're concentrating on, because I'm involved in the union and things, is the money, the dollar that they can pay them per hour. Not the insurance. They're not even asking questions about that. They want that dollar paid, and Clark County is one of them. They're going to want to up it to $21. What's that going to do to these people here that have to deal with it?
I just want to chime in on that because I do think that really changes the narrative of this conversation. To your point, as I was listening to you speak, I really do understand everything you're saying. But if we're asking for $1 million out of the general budget, I'd rather take $1 million and bump up pay for support staff so we can get some help, like drivers, teachers, and aides. So I think that's where that gets tough, is if we're talking about a general budget decision that only affects a small group of people and for 90 days. But that being said, if the processes and systems don't exist right now to make it happen anyways, I think it's a little bit of a moot point for a minute. I think we got to just let some things shake out, not put pressure on you guys anymore.
Yeah, I agree.
And I agree that, but $1 million, when you're looking at, is, I don't want to say a drop in the bucket, when like a 5% or 3% increase is a lot more than $1 million, right? Well, I know that was brought up in the past, but ultimately, the one thing that I think that if we sort of agree that we want to move forward with these conversations, we can look at Business Plus, or, is there a way at some point maybe to get to 60 days and then go to 30 days and work on, transitioning. I think that should be sort of the goal in mind, and the goal post where we're looking at how can we get there, what are some things we need to do, are there things that need to happen, and sort of have a plan. Because right now what we're doing is we're just getting together and we're talking about it every month, and and there's not like sort of the goal and how are we going to start moving toward that goal. So I think that I think it's just saying, hey, we want to get there. This is where we want to get to eventually, to 30 days. Right now we want to start, can we do that incrementally at 60 days once, Business Pros in, maybe in year 24, but again, if we're getting updated and we're looking at that and sort of putting a plan together to get there, and then we can make a recommendation. But I agree that we're not at a point where we don't want a disaster. I totally agree with you there, because employees just get more upset then, and we get lots of phone calls. Or you do.
I think we can get to the point of starting to make goals once we have our system in place. Right now, it's hard for me to say, let's have a goal of January 2023, whatever it might be, when I really literally cannot promise you anything right now. So I hate to say that, but I kind of feel like it's over-promising and then under-delivering, and I don't want to do that. I want to be realistic as much as possible. So I think once we actually get the system to completely work with Business Plus, and we have everything working with Business Plus, it also connects to Anthem. It's also going to connect to other carriers. I think then we can look at, hey, what's realistic? And then we can really start gathering real data that's pretty meaningful to us, and understanding of what is realistic in terms of setting goals.
And I think you touched on it before. I think we're perfectly comfortable providing regular updates on where we are to that end, right? Because the
Yes,
work
absolutely.
is progressing,
Mhm.
and
Yep.
you know, testing is happening, and so whether it's monthly or every other month, we certainly can provide an update on what's happening with that implementation. And shortening the timeline aside, this is as much about that decision as it is making our operations more efficient, right? For better member service. So, Laura, I don't know if you remember exactly what the numbers were, but I shared with the Board of Trustees during the budget process that, typical kind of benefits representative to members ratio is somewhere between 1 to 1,000 or 1,500 members, and we're hovering around 4,000, 1 to 4,000. So just from a member experience perspective, this is mission critical for efficiencies and for experience. So we'd be happy to provide continuous updates on the work that's happening.
Eric?
Well, Laura, you were referencing a system that's going to connect to Anthem and whatnot. What systems are we looking at?
So the system that's being built is through Access, and SQL is on the back end. And this is about as technical as it gets because I'm not building it. It's similar to what we currently use for our retiree database. There just isn't a lot that we have to that connects to Business Plus. So when we move to another technology piece that Emily was speaking of, there may be another benefit administrator piece out there already that's already set up. We don't have to build anything on our side. But currently, because we have to go through this build process and make something custom to us, and that's where it's slow. There's not a predicted implementation time because this is the first time we've ever done anything like this. So that's why I hate saying I would love to say January, but I really don't want to put anything out there yet until we know that this is going to work.
So this is an in-house IT project
Yes.
done via Access?
Yes.
Okay.
Yes.
Thank you. And then I just had one follow-up comment, Mike. What I was going to bring up was the fact that the $1 million that we were referencing, and I don't want to get too much into the financials because I'm not a CFO, nor is Mark here to reference a few things, but my understanding of Mark's presentation is that it's not necessarily $1 million cost up front, but it's $1 million budgeted that's already there, going to be spent just 60 days sooner. In my estimation, maybe you can help me out.
Yeah, so that would be an additional cost to the general fund that's unbudgeted. So it would have to go through the budget process and be approved by the board if we were in a position to move forward with it. As here's all the things. Our general fund budget funds a tremendous amount of things. So what are our priorities? What are our resources? What can we fit in there? And that's where the board would make the decisions in the future about that.
Right. I just had remembered asking Mark specifically that any FTE that was already approved has that in there less 90 days at the beginning.
Correct.
And that with the current FTEs, it would be a difference of $1 million, just not budgeted. Available but not budgeted, or potentially there but not budgeted. It was more of a question of whether or not it was available but not realized cost.
I think I understand your question now. So we don't budget for the cost of that premium during that 90-day wait period. So it's not that we have a savings there and we just don't, or we budget it and we're not having a cost. It's not budgeted for and there is no cost. So if we were to have a cost of, let's say, to 60 days and add that 1 month in there, well, now we have an unbudgeted cost. So we would have to approve budget appropriation for that additional cost. I hope that help clears it up.
Can I ask a clarifying
It does,
question?
and some of my rudimentary math doesn't equal a million, which is why, like I said, I didn't want to get too close into it, only because Mark wasn't here and I didn't mean to cut you off either. But thank you for your explanation. It does explain a bit. I was just under the impression that we're missing 2 months, essentially going down to 30 days on each FTE that is unfilled.
I think Mark was also talking about all of the hiring that we do on an annual basis, so it wouldn't just be the jobs that are unfilled right now, but it would be all the people that we hire.
Over the course
So
of a year.
what I was going to say, and if this is not a correct summary, just erase it from your memories, but so when we're looking at budgeting positions, instead of budgeting for 9 months of insurance, we're now budgeting for 12 months of insurance if we make this change. Or 10 if we go to 30 days, right? So you'd be budgeting for 11 months instead of.
That's correct. And that's where we would see the increased cost for the
overall
budget.
expense.
Right.
Okay, so as we're in a bit of a holding period, as we go through IT and the lovely Access program, I've built things in it, it's awful, and I'm sorry that that's what you're dealing with. So there are several things that have come up as, oh, well, we'll have to address this. Can we start addressing those things if we know that we're planning on or we want to get to a spot where we reduce this? Whether it's for hiring purposes, whether it's for humanitarian purposes, if that's our plan and we need to deal with coordination of leave policies, waiver of premium policies, other stuff, can that be stuff that we start dealing with as we're working on pulling out the bugs in the online system?
The short answer is yes. But I think we just have to kind of look at each of those things in isolation. So leave policies, for example, I can't touch until we're bargaining again. But I'd look to Laura for like the waiver of premium question.
Can I copy her answer? Yeah. Yeah, I do think the waiver of premium is built, the language is built into our plan document. So I definitely think that's a piece that we can look at. I just would need to explore a time frame of when we could actually make that change. But looking at that, we can start that soon, yes. Mm-hmm.
The only thing that makes it a little bit tricky, but we can try to work it out, is I think the waiver of premium language is somewhat tied to leave language. So those two things could be a little bit interconnected, but no, there's absolutely nothing stopping research from happening in terms of, you know, the different channels or the different roads we'll have to go down when we are in a position to do it.
Any other questions? No? It's time. We still have a couple agenda items.
According to your previous statement, we can stay for 10 minutes.
Okay, good. We can get through the next, we'll move on to the next agenda item then. That is the 2.08, approval of the minutes of the April 27, 2022 meeting of the Group Insurance Committee meeting for possible action. Were there any, hopefully you read through them, they were sent out. You'll notice, I just want to point out, I know people come in late, rather than being listed in the roll call area, because you're not listed there, as we noted last time, you're noted when you come in, so Tony came in, and then Diane came in at 4:23, so they are noted in there, so that's, hopefully everybody knows that. Any other changes?
That's what took me so stinking long.
No. Oh, I totally get the traffic.
No, detour.
Oh.
I got down here to come in from the university there,
Uh-huh.
like I usually do. Their detour, I had to go back up to the McCarran, come down Valley.
Oh,
To
jeez.
come here. So that's what took me.
Okay.
So sorry, I was even later than last
No,
time.
it's okay. We're just glad you're here.
I'll move to approve the minutes.
Okay, it's been moved. Is there a second?
I'll second.
It's been moved and seconded to approve the minutes and thirded. All in favor of approving the minutes, say aye.
Aye.
Opposed, nay. Okay, motion carries. And then The next meeting of the group insurance committee will take place on Wednesday. No, that's last, those are the minutes.
I just
sorry.
wanted to make a quick comment on
Go
that
ahead,
next
please
meeting.
do.
So it's scheduled for June 22nd. We have at least a couple of members who aren't going to be able to make it. We're going to send out an email probably tomorrow, maybe from Veronica. And so if you could just check your email, I just want to see like a show of hands of who could potentially make a different date we're looking at. And if we don't have all of our members who can, or the majority, then we'll continue and stay with the June 22nd date. The other date we're looking at is June 16th. So I don't expect you to check your calendars now, but please respond through email just to let us know. And if it doesn't work, that's okay. We'll hold the June 22nd date.
June 16th, yeah.
Okay.
Tony, are you going to RA? No. Oh, okay.
Yeah, that's fine.
That's why
Okay.
two of us aren't going to be here, I know for sure. And are you
Yeah.
going to RA?
So I wasn't planning on going to RA, but my question was, does offering a Zoom option solve some of our issues? Like, can we hold the meeting virtually?
On June 22nd,
Yeah.
virtually?
Mm-hmm.
The whole meeting can't be held virtually because the emergency declaration is no longer in effect. And so the meeting law provisions are back to normal, but you can have people participate virtually.
Thank you.
The only comment that I have is I believe that Dawn and I, that is the day we're actually flying out, so we would be on a plane, so that would be hard to even do virtually. But any day before that, or, virtually I could do it after that, but that's the day I happen to be on a flight all day to Florida. So.
Okay, so we'll send the email, and if that doesn't work, then we will hold it June 22nd with a virtual option at least, just in case. Okay.
Quick question before we
Yes.
go. So just to confirm, right now it's set for June 22nd between
Yes.
4 and 6 in here.
Yes.
And what is RA?
RA is Representative Assembly. It's the NEA has, and it's in Chicago.
Possibly. We'll have to
Sorry,
look at see if this
and
one's
so
open.
those who belong to NSEA, the Nevada State Education Association, some of us are going to RA for that, for the Representative Assembly. Thanks. Good questions. Okay, seeing no other business, we're adjourned.